Welcome to Module C of BFM, Treasury Management. In this module, we will understand how banks manage their funds, liquidity, investment, and risk through treasury operations. We will cover key areas such as money market and forex market operations, bond valuation, duration, and risk management, derivatives, and asset liability management. Treasury plays a crucial role in ensuring profitability while maintaining liquidity and regulatory compliance. And by the end of this chapter, this module, you will have a clear understanding of how bank treasuries function and manage financial risk effectively. So let's start with module C.
In this chapter, we will learn that what is treasury, what is treasury management, how banks do this management, and all the details of this module C. This module is one of the easiest module in BFM, but we can't ignore this module because we have asked the questions from this module also. So stay tuned and let's revise the things related to this module and we will secure our 10 to 15 marks. So let's start with the class. Here, if I talk about the treasury, what is the meaning of treasury? That treasury is the department of a bank that connects its core business with the financial market. When the bank that connects the core business with the financial markets. And what is the core activities of a bank? Obviously, taking the deposit, lending the loans. Two things are most important. Taking the deposit, lending the loans. So how treasury fits in? Treasury continuously deals with financial markets, right? Treasury continuously deals with the financial market. Why? Just to borrow the money, just to lend the money, just to invest the funds, just to trade the financial instruments. This role, this role is very similar to the corporate treasury in non-banking companies, which manages cash funding and the financial risk. Okay, so that means we can say that treasury is one of the most important thing that playing a very important role in the banks, right? So, if we say that this module is important, we have to learn this module, we have to understand this module because not just for that this module is easy, so we can skip that. That is not good. We have to do this module and as well as D module. So it is important, very important to understand about the treasury first. Then what are the products of treasury? What is the meaning of IDR, CRR, SLR, and lots of things, right? So let's start. Okay. So treasury is the department of a bank that connects its core business with the financial markets. What are the core activities of a bank? Deposit taking, lending. And how treasury fits in? I told you that all things that this treasury is related to the corporate treasury in the non-bank companies which manages cash, funding, and as well as the financial risk. Now, what is the role of treasury in asset liability management? Asset liability management means when the mismatch between assets and liabilities are matched, that is the role of treasury. And treasury role is just to ensure the bank has enough funds at the right time, obviously, which is most important, that bank have enough funds, right? Next, we can say here that uh, integrated treasury, meaning that there is a concept of integrated treasury also. I will explain you about that concept, But first learn there that what is the role of treasury in the asset liability management. That asset liability management means just matching the mismatch between assets and liabilities. And that ensures that bank has enough funds at the right time. It controls interest rate risk and liquidity risk, right? Example, if the deposit is just here for 1 year maturity and loans are here for the 10-year maturity, this mismatch can cause liquidity problems, right? So treasury manages this using money market borrowing, bonds or derivatives, right? Is that clear that how treasury is managed in the banks? Okay. Now, next thing is there that integrated treasury. The most important thing is integrated treasury. Integrated treasury means combining the money market operations, right? Securities market operations, as well as Forex exchange operations. And all these are there in one system, one integrated system, right? One integrated system required here. Okay. So integrated treasury means simple. That means when the money market operations, securities market operation, foreign exchange operations are there in one coordinated system. So why this integration is important? Because decisions in one market affect the others. It helps in better risk control and profit optimization. Example, if interest rate falls, bond price rise, currency obviously weakens here. Integrated treasury captures the opportunities across all the markets together. That's why integrated treasury is most important thing, right? Because it captures opportunities in all the organizations, all the markets together. Is that clear? So that concept is very important for examination, that integrated treasury. So let's move to the next one. What are the driving forces of integrated treasury? Driving forces of integrated treasury. First is integrated cash flow management. Integrated cash flow management, which manages the cash flows across the currencies and countries, right? Example, if there is a multinational company that receives US dollar in the US and needs INR in the India. So treasury plans optimal conversion here and also do the fund movement, right? Then interest arbitrage. What is the meaning of interest arbitrage? Simple, earning profit from the arbitrage. Earning for profit from the arbitrage. Basically, what is the arbitrage? Where the one market is low and another market is on high. So buy from this market and sell into this market. That difference between the interest is called arbitrage, interest arbitrage. Suppose borrow at 4% in the US and invest 7% in the India. That net gain is there is the interest arbitrage, right? Then we have here access to the global resources. Access to the global resources. Here, its ability to raise the funds, ability to raise the funds from the international markets, right? Issuing the bonds in London instead of India due to lower interest rate. That is possible just because of treasury market. Now, corporate demand for high-end services. Corporate demand for high-end services means corporate need forex hedging, obviously. Also, some type of structured products, right? And advisory services. Advisory services means if an exporter here suppose wants to protect against US dollar INR fluctuation. In that case, Treasury provides a forward contract, right? Then last we have risk management, which is most important. Why? Because managing the risk related to interest rate, exchange rate, market prices, that is important. And Treasury uses interest rate swap to protect against rising rates, right? Now, here, let's learn about the functions of integrated treasury. First, they have to meet the reserve requirements, and the most important requirement is here CRR and SLR. And what is this cash reserve ratio and statutory liquidity ratio? What is the meaning of CRR and SLR? If I talk about the CRR and SLR both are the monetary policy tools which is generally used by the RBI just to regulate the liquidity and credit growth, right? CRR requires bank to hold a percentage of deposits in the cash with the RBI, while SLR mandates holding a percent of deposits in liquid assets, that is cash, gold, or approved securities, right? That is basically cash, gold, or approved securities. That is CRR and SLR. So here, bank have to keep CRR, cash with the RBI, SLR in the form of liquid assets, government securities. Treasury ensures enough government bonds are held to meet the SLR. And also global cash management, managing the surplus and deficit funds globally. Suppose excess cash in Singapore branch used to fund London branch needs. Excess cash in Singapore branch used to fund London branch needs. Then we have the next function that is merchant banking and advisory services. Obviously, in integrated treasury, forex services, hedging solution, financial advice, everything is available. Helping a company issuing a foreign currency bond that is available in integrated treasury. Profit optimization. Treasury earns the profit by trading in the forex market, by doing the currency trading, buying the US dollar at 80 rupees, 82 rupees, and selling at the 82.50 rupees. Money market, where short-term instruments, T-bills, CPs, commercial deposits, are available here, and suppose investing overnight surplus in the call money market and securities market like debt, equity and derivatives, buying the government bonds before interest rate cuts. Risk management, managing the market risk of a bank using like every risk is managed in this. Then we have three distinct roles of treasury. First, we have the liquidity management. three distinct roles of treasury: liquidity management, which ensure that enough cash is available in the short term, medium term, and long term in different currencies. It manages daily cash withdrawal while funding the long term loans. Right? Clear with the liquidity management? This is first role. Then we have uh, proprietary trading. Trading with the bank's money to earn the profit. Trading with the bank's money to earn the profit. Like trading in government bonds or currency derivatives. Right? Then here, risk management role. Obviously. Third one, because treasury helps management by reducing the ALM mismatches, right? By providing derivatives to clients, managing the risk in proprietary trading.
Right? So that is the risk management role, we can say that, which basically helps in different things helped by the treasury. Okay. That is the that is the three important roles of treasury. So we can say treasury is the financial nerve center of a bank, which manages liquidity, profitability, risk by integrating the money, forex, securities market in the globalized financial system. Got it? Now, globalization. What is the meaning of this globalization? Integration. Integration of domestic economy with the global economy. Integration of the domestic economy with the global economy, where very few free capital flows is there and very low restrictions are there. Indian companies raising the funds in US or Europe, making the domestic economy merge with the global economy. Then capital account fund flows, routes. What is the meaning of portfolio investment? Investment in shares, bonds, mutual funds. Example, foreign investor buying the Indian stock market shares, where the foreign investor buying the Indian stock market shares. Then direct investment, long-term investment with management control, where a foreign company setting up a factory in the India. External commercial borrowings, loan raised from the foreign lenders, as we learned this in our module A. Issuing of equity debt in the global markets like ADR, GDR, foreign bonds, right? Then mergers and acquisition, cross-border mergers, Indian company acquiring a UK firm, that is, we can say, is the merger and acquisition. And you can say that payment for technology and services like fees, royalties and consulting charges. Paying the royalties to a foreign company for a patented technology, that is, we can include, is the like it is a type of treasury function, right? Now, what is the impact of globalization on treasury? What is the impact actually? See, globalization impacted the treasury in many ways. It basically affects the treasury operations immediately and directly also. Its impact is mainly threefold. Right? It impacts in threefold. First, impact of interest rate. Impact on interest rate and exchange rates. Interest rates are the heart of treasury operations because treasury deals in lending, borrowing and investment. Interest rate are the heart of treasury operations because treasury deals in lending, borrowing and investment. And with globalization, money can move freely across the countries. Investors compare returns globally. Domestic interest rates are influenced by the global interest rate trends. So whatever the changes in interest rate, they also affect the exchange rates. Right? And how it works? Generally, whenever the interest rate rise in the US, foreign investors move their funds from India to the US, obviously. And demand for US dollar obviously increases. Rupee depreciate, RBI have to adjust the domestic rate just to control the capital flows. So if US rate is 6%, India interest rate is 5%. Investor prefer US assets. Capital flowing out of India. Rupee weakens and treasury must manage this interest rate risk and currency risk. And now here, what is development of financial market infrastructure? Obviously, it is important to develop the market infrastructure to compete with the global level. Domestic market have to compete with global markets. So, transparency is important, efficiency is important, investor protection is important, risk management is important. So, new institutions and regulators were created. And what are the regulatory institutions? Who are the regulatory institutions? SEBI regulates securities market. IRDA regulates insurance market. Right? Then this is, we can say, development of financial sector. Now, development in basically market support some institutions like CCIL. Right, Clearing Corporation of India Limited, which handles clearing and settlement of money, forex and government securities. And also NSDL and CDSL, means electronic holding of securities in demat form. Earlier bonds trade settled manually. There is a high risk. Now CCIL guarantees the settlement, which means lower counterparty risk, which enables treasury to trade confidently at high volumes. Right? So then, expansion of treasury product, RBI gradually allowing rupee derivatives. So treasury can offer hedging the tools, structured products, risk management solutions. And this is widened the product basket of treasury. RBI allowed IRFS on recognized stock exchanges. And for 91 days, for 2, 5, 10 years, and coupon bearing securities. Here we can take the example. Suppose if bank expect interest rates to rise, rising rate, bond price fall. So treasury use IRF to hedge the losses in bond portfolio. So why this, we can say, evolving role of treasury at profit center. Basically, in early days, treasury was a service center only managed short-term cash flows, operated money mainly in the money market. Profit generated was not a priority. But in present integrated treasury, banks now actively trade in market, use the derivative, generate the surplus profits. So treasury has become a strategic profit center. So treasury profit becomes attractive. But why? Because there is a low credit risk. Treasury operate mainly in the interbank market. Counterparties are bank or RBI regulated entities. Credit risk is very minimal. So lending overnight funds to another bank in the call money market is the example of this. And one more thing is, if the high leverage, that means high return. High leverage means high return. Treasury uses the borrowed fund. Even small price movement generate the large profits. Right? So if 0.10% movement, bond yield can create huge trading gains on large volumes. Then very low operating cost. Low operating costs means no branches, no large staff, no physical infrastructure, right? Retail banking. A very few dealers can handle the transactions worth thousands of crores daily. So globalization has transformed the treasury from a passive service unit to a dynamic profit center by just linking the domestic market to the global interest rate, which is strengthening the market infrastructure, which expanding the product offering through the derivatives. Right? So what are the sources of treasury profits? Foreign exchange business. Bank buy and sell the foreign currency for customers. That buy and sell difference is profit. Suppose if bank buys US dollar at 82 rupees and sells at 82.30, that 0.30 per US dollar is the profit. So Forex business, that Forex business is the major source of other income. Then money market deals, lending the surplus funds in call money, repo market, treasury bills. These all are the money market deals. Bank lends 500 crore overnight at 6% interest on treasury income. Investment activity. Investments mainly in the government securities, SLR bonds, that considered low return but risk free. If bank invest in insurance or asset management subsidiary, the objectives are long-term strategic presence, not immediate profit. And profits in contemporary treasury. Treasury profit mainly comes from forex buying and selling, interest on investment, money market lending, and also trading in bond and derivatives. So active trading in government securities during the interest rate cycles, structured forex products for the corporates. Right? And basically treasury operations, in which we know that now treasury is the profit center, which having lots of activities. So interest arbitrage is the main activity where the interest is low, buying from that and just selling in another where interest rates are high. That difference between the interest is the profit. So interest arbitrage means earning risk free or low risk profit by taking advantage of interest rate differences between domestic and foreign market, different financial instruments. This treasury borrows or deploys the funds where rates are lower and invest where returns are higher. Right? So, suppose if a bank has surplus rupees, and domestic short lending rate is only 3.50%, short lending rate. By using foreign exchange swap and overseas deposit, treasury earns here swap return of 4.7% and US deposit interest only 0.15%. So total return is here 4.32%. Right? What is the arbitrage gain? Arbitrage gain is about 0.82%, the difference of them. So this extra 0.82% is the arbitrage profit which earned without taking significant risk. So integrated treasury allows better fund utilization. Arbitrage profit rise due to market inefficiencies, and treasury always chooses the highest risk adjusted return. Right? Then arbitrage between over the counter and future market. Treasury earns profit when the same instrument is priced differently in the OTC or in the exchange traded future market. Suppose if US dollar forward rate in OTC market is 83 rupees and future price is 83.30. So treasury buys in OTC, sells in future. That's 0.10 per US dollar, almost risk free. Trading income, speculative profit. It is a speculative activity where profit is earned from the price movements of securities, foreign currencies, interest rate instruments. So example, if treasury buys government securities at 98, later sells at 100 rupees, that 2 rupees per 100 rupees is the profit. So trading involves market risk unlike arbitrage. Now treasury products, customer deals. Treasury designs the financial products to help the customers in managing the currency and interest rate risks. Example, if a company has floating rate US dollar loan, currency risk, interest rate risk, here what treasury do? Convert the US dollar loan into the rupee loan, convert the floating interest rate into the fixed interest. So difference is the treasury quote here a rate slightly higher than the market, and that difference is the profit. So spread is a guaranteed income for the bank. Right? Then treasury and transfer pricing. Transfer pricing is the internal pricing of funds between the treasury and branches and different departments of the bank. Suppose if treasury provides funds to branch at 6%, branch lends to customer at 9%. That 3% is the branch margin, which ensures fair performance measurement and proper cost allocation. Right? And then treasury functions either as a department or as a specialized branch under the head office. It depends on the complexity of the bank. Right? It depends on the complexity of the bank It has functional autonomy and its own accounting system. And who are the heads of treasury? Obviously, general manager, chief treasury officer, vice president, or equivalent. Right? So, already we can say that these are the things in the treasury, right? These are the, basically you can say, organization of the treasury is generally who are the heads: general manager, CTO, vice president. And there are three tier structure of treasury. First important, front office, which is the main profit center, which executes the market deals, where buying and selling of Forex, money market instruments, government securities. It deals only in secondary market but may participate in the primary auctions. Front office does not handle any type of settlement. It only handles the basically deals in the secondary market and basically do buying and selling only. Right? Then we have mid office and back office. Back office generally related to the treasury administration, which do the deal confirmation, settlement of transactions, accounting and reconciliation. Settlement means receipt and payment on value date. Mid office, monitoring the risk exposure, checking the position limits, stop loss limits, preparing MIS for the management, and ensures treasury activities remain within the approved limit. Right? And what is the meaning of this MIS? It is very important in the banks or any organization. MIS, Management Information System, which basically collects, store and analyzes the data for decision making, reporting and operational efficiency. Right? And then we have here you can say that like investment department. In the investment department, that it deals with primary market investment, right? Also, it prepares investment proposals. It obtains the approval at appropriate authority level, and it have minimum marketable investment, generally 5 crore, right? And some other functions are there of the treasury, that is accounts and administration. What is the meaning of this? You can say that accounting, do the compliance, do the reporting, and there is also the system administration. In the system administration, we can include like treasury software, risk systems, and what is the connectivity, and remittances is generally via SWIFT, NEFT, RTGS, and some international settlements. These are the functions of the treasury, right? So Basically, treasury management is what is just a strategic oversight of a financial institution, liquidity, capital, and risk, which ensures sufficient funds for operations while optimizing the returns. In this, it manages daily cash flows, regulatory reserves, and investments in money market bonds. It acts as a bridge, securing the deposits, managing the funding needs, and also mitigate market operational risk to maintain financial stability. And what are the core functions of treasury? It's help in the liquidity management, asset liability management, risk mitigation, investment portfolio, and also the regulatory compliance. So that basically the components of banking treasury, in which it's do money market, bond division, foreign exchange, handles all the international currency trading, deals with the currencies like US dollar and the euros. And you can say in this, it basically have a lots of purpose just to manage the problems of the bank, just to provide the corporate treasury services, because bank also provide treasury services to the clients, which help them manage their own cash, liquidity, and financial risk. So effective treasury management is very helpful in reducing financial risk, optimizing the work capital, improves the profitability through smart investment, and also enhances the ability to navigate the financial uncertainty. Every bank has a brain that decides where money should be placed, when it should move, and how risk should be managed. That brain is the treasury, and its tools are called treasury products. When the interest rate change or the rupee fluctuates, who protects the bank from losses and also creates profits? The answer lies in the treasury products. So, good evening everyone. I hope you all are fine and doing well, and also I am audible. My screen is visible. So, let's start today with treasury products, where we will discuss some important topics, concepts about the treasury products, and discuss some questions. So, let's start with the class. So, if I talk about the treasury products, first let's understand that what is foreign exchange market. This is a global marketplace where trading, buying and selling of securities are happen, where the currencies of different currencies are bought and sold. That is a global market where the currencies of different currencies are bought and sold. This is the most liquid market in the world, because here are the major currencies like US dollar, euros, British pound, Japanese yen, CHF. These are the freely convertible currencies, and there is huge volume of trade happens in every second. Free currencies belong to the countries with highly developed financial markets where exchange controls are minimal or absent. So, example, US dollar is freely convertible into the INR. Euros is convertible in US dollar. These trades happen easily without heavy restrictions. Without any heavy restrictions. That is the foreign exchange market. But what are the features of this foreign exchange market? First, this is very transparent market. Transparent market means basically Forex is a transparent market because here all the trade happens online as well as electronically. All the trade happens in online format and electronically. And here the exchange rates are visible in real time. Right? So rates change movement to movement in every 4 seconds, and these are shown on the screens as well. Even if a trade happens in New York, Tokyo, the impact is instantly visible worldwide. So suppose if US dollar strengthens in the US market, Indian dealers immediately see the new US dollar INR rate on their screens. Right? Then second is the feature which is virtual market, no physical location. Yes, Forex market has no physical boundaries. It operates through computers, networks and telecom systems. It exists virtually across the globe. The only limitation is domestic regulations, currency convertible rules, because US dollar can be freely traded globally, but INR trading is subject to the RBI rules. Right? Then there is very fast information dissemination. Means electronic dealing platforms in the basically whatever the information in the Forex market spreads extremely fast because of electronic dealing platforms, information vendors like Bloomberg, Reuters. These all are the information vendors, and these platforms who shows the live exchange rates, these allow the dealers to buy and sell the currencies instantly, as well as here these shows the live exchange rates, and buyers and sellers are here available. But banks also have their own online Forex platforms. Customers can do online Forex transaction. Forex brokers worldwide uses here the telecom networks. So example, suppose a corporate exporter logs into a business Forex portal and books US dollar at the live rate whatever shows on the screen. So that is very good feature of this Forex market. Then we can say this market is highly liquid. Highly liquid market means that Forex market is opens 24 hours, 7 days in a week. Right? Why? Because different market opens in different time zones. We know that. In Asia, the time is different. In Europe, the time is different. In America, time is different. So traders can buy or sell currencies anytime. And here, they can exit their position very easily. So two-way quotes are provided, buy rate or sell rate. Liquidity rate is basically if the narrower buy sell spread means higher liquidity. Higher liquidity. Example, US dollar, INR. Suppose in the case of US dollar, INR, if the rate of buying is 83.20 and the sell rate is 83.22. So in that case, there is a small difference because of highly liquid market. Right? There is a small difference because of highly liquid market. Right? Okay. So here we can say these are the characteristics. First, this is transparent market. Here virtual market, no physical location is available. Fast information dissemination, and it is very highly liquid market. Now spot market. What is the meaning of that spot market? Very simple. Spot market, you can say that where the currencies are bought and sold for immediate delivery. This is one of the most common type of deal in the India. Immediate means T plus 2 days. Like if deal happens today, so settlement happens after 2 days. Spot refers to settlement, not to the trade date. Settlement happens 2 working days after the trade date. That is called T plus 2. If trade date is Monday, settlement date is Wednesday. It provided both on the working days. If suppose Wednesday is the public holiday or any sudden holiday, in that case the settlement date shifts to the next working day, next business working day. That is the spot market, one of the most common of deal. But when the deal happens today and also settlement happens today, that types of deals are called immediate type of deal, immediate or cash deal, where sometimes currencies can be bought and sold with same day settlement. This is called cash transaction or value today. If a bank urgently needs US dollar today to meet an obligation, so same settlement type of deal is used in these types of cases. Right? Now, here we can say that the simple thing is there. Forex market means most liquid market. What are the free currencies? US dollar, euros, Japanese yen, British pound, and market is always transparent, virtual, fast information flow is there, 24/7 available, two-way quotes improve the liquidity, spot market settlement, that means T plus 2, and same day settlement is also possible in that case. These are the things which are important to understand about the treasury products, right? Okay. Now some more things here. If I tell you about this treasury products, these treasury is one of the most important thing, right? And in that case we can say that forex market is also a very important concept which is used because it is the most liquid market, most transparent, virtual. Spot trades are, T plus 2 settlement is here. In the tomorrow, everything is settled tomorrow. In the forward rate, basically, while spot trade refers to the current transaction, but forward refer to the purchase or sale of currency on a future date, right? Treasury may enter into forward contract with the customers or with the banks as the counterparties. Okay. And forward rates always fully reflect interest rate differentials, but only in the perfect markets. Then swaps. Swaps, you can say, where the spot and forward transactions are the primary products in the foreign exchange market. And a swap transaction is always described as an exchange of cash flows. And combination of that spot and forward transaction or combination of two forward transaction is called swap, right? And then what is the meaning of money market? There is the thing about the money market. We are discussing about the money market. What is the meaning of that money market? Money market refers to raising and deploying the short-term resources with maturity of funds generally not exceeding 1 year. This interbank market is subdivided into call money, notice money, and as well as term money market, right? Call money means where the lending and borrowing for only 1 day. What is notice money? Where lending and borrowing for 2 days to 14 days. And term money, where the lending and borrowing for 15 days to 1 year. So call money refers to the overnight placements. right? Where the funds repaid on the next working day. And who are the primary dealers? Here the primary dealers are those who buys government securities directly from the government. Then we have notice money. What is this? Under the call money market, funds are transacted on overnight basis, whereas under notice money market, funds are transacted for a period between 2 days and 14 days. Right? Then we have the basically that is the money market, notice money market, call money market. Now term money. Term money is basically placement of the funds with banks for periods in excess of 14 days but not exceeding 1 year. That is the term money. Typically, term money placements range from 1 month to 6 months, and placements for long periods are not very common in that case. Right? Okay. Then we can say that is a concept of term money market. And currently CRR is 3% of bank demand and time liabilities. CRR is one of the important monetary policy instrument of RBI that influence the liquidity in the market. So what are the securities who deal mainly for placement of short-term funds? These are T-bills, CDs, certificate of deposit, cash management bill, commercial paper, and repo, LAF, liquidity adjustment funds, marginal standing facility, and centralized borrowing and lending obligations. Right? So and these are the things basically which include in the treasury products. Treasury bills, if I explain you the treasury bills, these are issued by the government of India through RBI banks for maturities of 91 days, 182 days and 364 days for predetermined amounts. Then we have cash management bill, where the government of India in consultation with the RBI decided to issue a new short-term instrument that is known as cash management bills, just to meet the temporary cash flow mismatch of government. Right? So commercial paper, it is a short-term market paper which is issued by corporate within minimum maturity of 7 days and maximum maturity of 1 year. Right? Okay. So that is about the commercial paper. And if I tell you about certificate of deposit, that is unsecured debt instrument which is like commercial paper but is issued by banks against the deposit of funds. Okay, so these are the things we can say in the treasury products. Now let's do some questions, in which first question is, what is the significance of Bombay Stock Exchange and National Stock Exchange in the India? What is the significance of them? Like, what is important about them, these two, the NSE and BSE? Simple, they are the leading stock exchanges. They are the leading stock exchanges. Means the Bombay Stock Exchange and the National Stock Exchange are the place where shares and securities are bought and sold in the India. Right? And some are the companies who list their shares on the BSE and NSE. Investors trade shares through these exchanges. They help in price discovery, liquidity, and smooth functioning of the capital market. So what is the correct answer here? Option C is the correct answer. They are the leading stock exchanges. So option C is correct here. Next question. What is the benefit to the issuer company when bondholders convert convertible bonds into the equity? What is the benefit of that issuer company when bondholders convert convertible bonds into the equity? See, simple, whenever bondholders convert their convertible bonds into the equity shares, the issuing company gets a big advantage. Debt is converted into equity, right? And companies, they do not have a money to repay the loan amount, right? So that obviously reduces the company's debt burden. That equity base becomes stronger, that improves the balance sheet. So here, which option is correct? The correct option is strengthening of equity base without debt repayment. So option B is correct here. Now, the next question. What is the key feature of convertible bonds that distinguishes them from the traditional bonds? What are the key feature of convertible bonds that distinguishes them from the traditional bonds? See, these convertible bonds are special. These convertible bonds are special because they give bondholders a choice. What choice? That convertible bonds are special. Why special? Because they earn interest like a normal bond. They convert the bond into equity shares of the company. And this conversion option is what makes convertible bonds different from the traditional bonds. So, which option is correct? Bondholders have the option to convert them into the equity. So, option B is correct here. Here, bondholders have the option to convert them into the equity. Now, next, why might bonds with put call options and step up coupons offer high interest in the early stages? Which option is correct? So the correct answer is here. Basically, bonds with the put or call options, these and the step up coupons, they offer pay the higher interest in the initial years. Why? to attract the investors to redeem early. Put option gives the investor the right to sell the bond back early, and call option gives the issuer the right to repay early. And what is step up coupon? Step up coupon where interest rate increases over the time. So higher early interest act as an incentive for early redemption, helping the issuer managing long-term cost or refinancing plans. So which option is correct here? Option A is correct, to encourage the early redemption. So A option is correct here, to encourage the early redemption. Why are banks allowed to invest only in demat securities, including corporate debt paper? Why the banks allowed to invest only in demat securities, including corporate debt paper? See, banks are allowed to invest only in dematerialized demat securities because these demat securities are online, right? And these are electronic, not the paper based, right? They reduce fraud, duplication, as well as loss of certificates. So trading, settlement and record keeping here become faster, safer and obviously more transparent. So it ensures transparency and ease of trading. So that's why banks are allowed to invest only in demat securities, which include corporate debt paper. So what is corporate debt paper in the context of security market products? What is the corporate debt paper? See, corporate debt papers are the debt instruments. These are the debt instruments which are basically issued by the companies and financial instruments. Companies and the financial instruments to raise the money from the market, right? So corporate debt paper means debt instrument issued by the companies and financial institutions to raise the money from the market, and these include bond, debenture, other medium and long term debt securities, and the issuer promises to pay regular interest to and repay the principal after the fixed period. So the correct answer is here option B, that is medium and long term bonds and debenture issued by corporates and the financial institutions. So option B is correct here. Next question, why is corporate debt paper referred to as non-SLR security? Why is corporate debt paper referred as non-SLR securities? Because in the banks of the India, they are required to maintain some percentage or certain portion of their deposits as a SLR, right? Statutory liquidity ratio, whatever the approved securities and government securities. In the approved and government securities, corporate debt paper is called non-SLR because it cannot be counted as the it cannot be counted for fulfilling the SLR requirement, bank's SLR requirement, and it here only government and approved securities are qualified for the SLR. So the correct answer is here option C. It is ineligible for meeting the SLR requirement of the banks. So correct option is option C. Now, what does STRIPS stands in the context of securities market? STRIPS. See, STRIPS is a method where bonds are split in two parts. Where bonds are split in two parts. First is interest coupon payment, and next is principal face value payment. Right? These parts are then traded separately as individual securities in the market. And obviously this helps investor who want regular income or who want a lump sum at maturity. So separate trading of registered interest and principal securities is the full form of STRIPS. Option B is correct here. Next question. How are the principal and interest treated in STRIPS in separate trading of registered interest and principal securities? As I told you this thing, that in STRIPS, a bond is broken into the parts. Each interest payment becomes a separate security. The principal also becomes a separate security. And these parts are always traded separately. They do not pay periodic interest. So that's why these are called zero coupon securities. Investor here earn the returns by buying them at a discount and receiving the full value at the maturity. So the correct answer is here option B, traded as separate zero coupon securities. B option is correct here. So what underlying securities were allowed for trading in the interest rate futures by the RBI in December 2013? What underlying securities? So, in December 2013, that RBI allowed interest rate futures to be traded based on Government of India securities, right? Now, not on the any corporate or municipal bond, and the permitted underlying securities were 91-day treasury bills and notional coupon bearing Government of India securities of 2-year, 5-year and 10 years maturity, which helped in improving the interest rate risk management, which increases the liquidity and the depth in the government securities market. So the correct answer is here 91-day treasury bill, 2-year, 5-year and 10-year coupon bearing notional GOL securities. Option B is correct here. What do banks and institutional investors actively do with government securities under the held for trading? See, under the held for trading category, banks and institutional investors, they actively buy and sell the government securities. Then they try to make the profit from short-term price movements. They do not intend to hold the securities till the maturity. So the correct answer is here option C, buy and sell in anticipation of the price changes. Option C is correct here. What type of securities consist of tradable securities and are placed under the trading book? What trading book includes? Trading book contains tradable securities, right? And that means securities that can be bought and sold in the market, right? So these are classified as held for trading, which is actively traded for short-term gains. Available for sale, that may be sold before maturity, depends on the market conditions. So that's why these two securities are consist of tradable securities and they are placed under the trading book. Available for sale and held for trading. Option B is correct here. What does the open market operations involve? What does the open market operations involve? See, whatever this OMO, these are the actions which are taken by the RBI, right? Why? To control the liquidity in the banking system. To control the liquidity in the banking system by buying and selling the government securities in the open market. When the RBI sells government security, it absorbs the liquidity. When RBI buys the government securities, it injects the liquidity in the system. When RBI sell the government securities, it absorbs the liquidity. Money moves from banks to the RBI. When RBI buy the government security, it injects the liquidity into the system. So OMO is commonly linked with selling government securities to absorb excess liquidity. So option B is correct here, that is selling the government securities to absorb the liquidity. Option B is correct here. Now, What is the purpose of government using securities in the open market operations? I told you that thing, that in OMOs, the RBI buy or sell the government securities just to control the amount of money in the banking system, right? Selling securities means absorbs the liquidity, right? Absorbs the liquidity, that means interest rate rise. Buying the securities means injecting the liquidity, interest rate falls. So the main purpose of using securities in OMO is just to manage the liquidity, when in turn influences the interest rate. So the correct answer is option C, to influence the interest rate by managing the liquidity. So option C is correct here. How our government securities are sold to the public? How the government of securities are sold to the public? See, these G-Secs, these are sold to the public basically through the auctions, which is organized by RBI. RBI conduct two types of auction: competitive bidding, where the large investors quote their desired yield or price; non-competitive bidding, where the small investors accept the yield determined by the auction. That process ensures transparency and fair pricing. So the correct answer is through auctions, which is conducted by the RBI. Option C is correct. Apart from government securities, what other approved securities can bank invest in to fulfill SLR requirements? I told you that thing, that banks in the India have to maintain their certain portion of their deposit at the SLR. But apart from the G-Secs, SLR eligible approved securities include whatever the bonds issued by the financial institutions, SIDB, that is Small Industries Development Bank of India, NABARD, that is National Bank for Agricultural and Rural Development. These securities help the bank in meeting the SLR requirements and support targeted sectors of the economy. So the correct answer is priority sector bonds issued by SIDB and NABARD. Option C is correct here. Why is a certificate of deposit considered an investment vehicle for corporate and banks? So CD, that is a short-term money, that is short-term money instrument, which is issued by banks and the financial institution. It is negotiable, meaning it can be sold or transferred to someone else before the maturity, right? And also, corporate and banks use the commercial deposit to park surplus funds safely for a short period. Interest is usually higher than a normal saving deposit, but the main attraction is tradability and liquidity. So the correct answer is here. It is a negotiable instrument. Option C is correct. What is the primary reason for relatively low credit risk associated with CP? As I told you, commercial paper is a short-term unsecured debt instrument which is issued by the companies to meet the working capital needs, right? So the credit risk is relatively low because short-term maturity is here, which reduces the chance of default. And only the companies with a minimum credit rating are allowed to issue CPs, which ensures financial stability. So it is a short-term nature and minimum credit rating requirement here. Option D is correct. Got it?
So let's start with the class where we will brush up our concepts and also we will do some questions related to this chapter. So for this, First, we have to know about, which is very important term, that is foreign FPI, about the FPI policies, foreign investments, and foreign direct investments. Okay, what is foreign investment? If we do any type of investment in overseas or abroad, that is called foreign investment. What is the meaning of foreign direct investment? In very easy, simple words, we can say that FDI means long-term investment by foreign person entity in an Indian company. Why? Just to influence the management or control. FDI means long-term investment by the foreign person, by the foreign entity in the Indian economy, just to influence the management or control, right? That is the meaning of FDI. Who, when is treated anything as any investment as the FDI? FDI always exists in two cases, right? When the investment in any unlisted Indian company, any percent of investment is called FDI. If any US company buys only 5% of shares of an unlisted Indian startup, so that 5% is considered as FDI because the company is unlisted. But if the company is listed, so in that case, 10% or more of post-issue paid-up capital is considered as FDI. If UK investor buys 12% of shares of TCS, this is FDI. Even if investment is 8%, then that is not FDI, it becomes FPI. So for a listed company, 10% is the demand. Now, the thing is there that, okay, that is clear. What is the meaning of this fully diluted basis? Which is very important thing. You must know about the fully diluted basis. Fully diluted basis means when the total shares, when the total shares that exist, if all the convertible instruments are converted into equity, whatever the total shares exist, if all the convertible instruments are converted into the equity, right? It includes equity shares, convertible debentures, convertible preference shares, ESOPs, warrants. Suppose if an Indian company has 1 lakh equity shares and 20,000 convertible debentures. So fully diluted shares means 1,20,000. Means here, if foreign investor hold 12,000 shares, and how much percent he is holding? Just do 12,000 divided by 1,20,000, which is about 10%. So that 10% means that is treated as FDI, right? That will treated as the FDI. Is that clear? What is the difference of listed and of an unlisted company? Now, fully diluted basis, I told you that thing. What is the meaning of fully diluted basis? When all the total shares, whatever exist, if their all convertible instruments are converted into the equity, that means the fully diluted basis. Clear? Okay. Now, FPI, portfolio foreign investment, foreign portfolio investment. FPI. What is the meaning of this FPI? The very popular term. FPI is one of the most popular term. FPI involves when foreigners purchasing securities like stock, bonds in another country's financial market without taking any direct ownership. When the foreigners purchasing securities like stock and bonds in another countries without taking any type of direct ownership. It is regulated by SEBI in the India, and FPIs are always categorized by the risk, right? So FPI is short-term market-based investment. No intention here is just to control the management. FPI, when it is at FPI, investment by foreign person in a listed Indian company where less than 10% of post equity paid up capital or 10%, less than 10% of each shares of capital instrument. So if a mutual fund buys 6% shares of the Infosys, that is called FPI. This is called FPI. Clear? So FDI for unlisted company, any percent is called FDI, but for a listed company, 10% is considered as FDI. For FPI, whatever it is short term and where the intention is not just to control the management, here the purchasing securities like stock, bond in another country's financial asset, that is called FPI, portfolio, foreign portfolio investment. Right? Okay. Now, FDI versus FPI. FDI nature is always long term. FPI nature is short term. Control in FDI is possible, but in FPI there is no control. How much percent are limited in FDI? Less than 10% for listed companies. And for FPI, more than 10%. In unlisted company, for FDI, any percent, and FPI it is not allowed. So what is the meaning of this foreign portfolio investor? Any foreign investor, any foreign investor who is registered with the SEBI, under SEBI Regulations Act 2014. A foreign investor, when registered with the SEBI under SEBI Regulations Act 2014. What are the examples of FPI? Foreign mutual funds, pension funds, insurance companies, sovereign wealth funds. Registration with the SEBI is mandatory here. That is the meaning of FPI. Clear? That is the meaning of FPI. Foreign portfolio investment. Sorry, investor. Now, what is the meaning of this foreign investment? As the name is foreign investment, so simple foreign investment is when Indian entities are doing investment abroad. Right? Foreign investment means it is the combination of FDI plus FPI. Combination of FDI plus FPI when the investment by the foreign resident in the capital instruments of Indian company or capital of an LLP. When the foreign investor do the investment in the capital instrument of Indian company and in the capital of an LLP. Investment must be on the repatriation basis. What is the meaning of repatriation? Repatriation means money can be taken back outside the India. Money can be taken back outside the India. Right? Okay. So that is the meaning of this. Basically, suppose if a Singapore company invest in equity shares of Indian company, so capital contribution in Indian LLP is there and both are the foreign investments. Both are the foreign investment. Clear? Okay. Now, here let's move to the next concept, that is, what are the prohibited sectors for foreign investment? Foreign investment is not allowed in the following sectors, where in the lottery business, government lottery, private lottery, online lottery, any type of lottery. Gambling and betting, like casinos, online betting platform, not allowed. Chit funds, generally prohibited. NRIs and OCIs are allowed only on non-repatriation basis. These are allowed, but they are not allowed to take the money outside the India. So, a listed company plus foreign money is FDI. Listed company plus more than 10% is FDI, and listed company less than 10% is FDI. Fully diluted means assume everything converts. FPI must be SEBI registered. Lottery gambling is always prohibited. Clear? And Nidhi companies trading in TDRs, these are also not allowed. What is the meaning of GDR? Very important. GDR, ADR, both are siblings. In which global depository receipts, what is the meaning of the GDR? And as well as we will learn about ADR also. GDR means these are basically, uh, you can just think that GDRs are the similar to the ADRs or IDRs. Both are same. But what is the meaning of this GDR? See, you can think like that. It is a negotiable financial instrument which is issued by the international bank, and they represent foreign company shares which are traded on exchange outside the issuer home country, which is London, and they allow the company to raise foreign capital from institutional investors in the currencies like US dollar and euros. Right? So, certificates issued outside India representing the equity shares of an Indian company, investor hold GDR, not the direct shares. And how it works? When the Indian company issue the shares, shares are kept within a custodian bank in India. Against these shares, GDRs are issued abroad. Investors can convert GDRs into the equity share. So if the Reliance issue GDRs in the London, foreign investor buys the GDR, later convert GDRs into the Reliance equity shares. That is the meaning of GDR, right? Global Depository Receipt. It is a bank certificate that represents the shares in an international company. Now, what is the meaning of trade credit? Trade credit are medium-term loans which is taken from outside India to pay the importers. A short-term medium-term loan which is taken outside India to pay the importers. And credit is extended by overseas supplier, overseas bank, financial institution, and some other recognized lenders. For importing capital goods, non-capital goods like machines, equipment, and for also the non-capital goods like raw material and consumables. That is the meaning of trade credit. Right? Now, what are the forms of trade credit? Obviously, one credit is for buyers when the loans taken by the Indian importers, and uh, these basically from the overseas bank and the financial institutions. Importer here pays supplier immediately and then repays the bank later. Example, if Airline Airport, Indian airline import aircraft part, take loan from foreign bank, that is called buyer credit. And what is supplier credit? When credit given directly by the foreign supplier. Importer pays suppliers after a period. So German machinery supplier allow the Indian company to pay after 6 months. It is called supplier's credit. Right? Two types of trade credit, buyer credit and supplier credit. Who are the eligible borrowers of this? Who are the eligible borrowers? See, only those person who are the resident in India and they are acting as the importer. They are here in the India are acting as a importer, right? Foreign company is not eligible. If Indian private company importing the crude oil, that is eligible in this. Then you can say whatever the amount under the automatic route means oil, gas, refining, marketing, airlines, shipping companies. These are there in this and up to US dollar 150 million per transaction, and other importers are only up to US dollar 50 millions are. So airline is there, they can take up to US dollar 150 million, but textile company, they only import US dollar 50 million here, not more than that. And for suppliers credit, suppliers of the goods who are located outside the India, they are the eligible borrowers. And for the buyer credit, overseas banks, overseas financial institution, foreign equity holders, they are eligible for the buyer credit. So Indian banks, NBFCs in IFSC, they allow according to the RBI prudential norms. But foreign branches, subsidiaries of Indian banks, these are only allowed by the trade credits, right? And then what is the maturity of the trade credit? Up to 3 years from the date of shipment. For non-capital goods, only 1 year. Or operating cycle, whichever is less. For shipyards, shipbuilders, non-capital goods, trade credit can be up to 3 years. Example, import of machinery, 3 years eligible. Import of raw cotton, 1 year is eligible. And shipyard importing steel plates, 3 years are allowed here. Then important concept, all-in sealing cost means interest plus charges. For existing trade credit, LIBOR is there, benchmark plus 350 basis point. For new trade credit, benchmark plus 300 basis point. For INR denominated trade credit, benchmark plus 250 basis point. And it includes interest, fees, charges, expenses. And then IDR, most important, Indian Depository Receipt. Indian Depository Receipts are the financial instruments in the India that represent shares of foreign company. These are the financial instruments in the India that represents the shares of a foreign company. And foreign company raises the money from Indian investors. They issue IDRs which have to follow the regulations. Some regulation. Issuing of IDR have to follow some regulations like Companies Rule 2014, then SEBI Regulations 2009. It can be denominated only in the INR. Proceeds must be repatriated outside the India on immediate basis. Right? So example, if an UK company is there that issues the IDR in the India, so whatever the money collected in the IDR, all the money is sent abroad. Right? Then purchase and sale of IDR. Purchase and sale of IDR. Eligible investors, foreign portfolio investors, NRIs, OCIs, their overall cap is $5 million for issuing the IDRs in the India, right? And uh, apart from this, we can say buyer credit is related to the bank loan, supplier credit is related to the supplier loan. Capital goods under the trade credit is just for 3 years. Non-capital goods are for 1 year. And INRTC, no foreign currency conversion is allowed there. IDRs are denominated in INR only, and ECB guarantee by the Indian banks is not allowed, completely not allowed. So, what is the meaning of external commercial borrowing? This is a type of loan which is basically raised by our Indian entities from the foreign, basically lenders, and according to the RBI rules. In automatic route, $750 million per financial year is allowed, and it can be enhanced to 1.5 billion. And if ECB is taken from the foreign equity holder, so that means in that case, liability equity ratio must be maintained 7:1. So if equity is 10 million, so ECB is only allowed to 70 million. And Indian banks, financial institution, NBFCs, they cannot issue guarantees for a ECB. Financial intermediaries, they cannot invest in FCCBs and FCEBs. What are the meaning of rupee denominated bonds? Rupee denominated bonds are those bonds which are issued outside India. These are denominated in the INR. Issuer receives money from overseas investor. Forex risk is borne by the investor, not by the issuer. And their famous name is masala bonds in the India. They are issued outside India. They are denominated in the INR. The issuer receives money from the overseas investor. And here forex risk is also not borne by the issuer. An RBI circular, according to the RBI circular of 3 November 2016, RBI permitted the banks to issue the rupee denominated bonds overseas for the specific purposes only. For some specific purposes, like uh, permitted purposes for issuing the RDBs, rupee denominated bonds, for for which issue, for which purpose? That we can say perpetual debt instrument. Perpetual debt instruments are there included in the additional Tier 1 capital. It is governed by the Basel third capital regulations. And why it is used? Just to give strength the bank's core capital. So if a bank issues perpetual bond overseas in the INR, they have to meet the 81 additional Tier 1 capital requirement. Right? Tier 2 capital instrument, you can include long-term subordinated debt, which is counted as Tier 2 capital under the Basel third. Bank issues INR bond overseas with the maturity of 10 years that is used as Tier 2 capital. It is allowed. And financing of infrastructure and affordable housing. Funds can be used for road, port, power, metro projects, low-cost housing projects. So if bank raises INR funds overseas and lends to affordable housing project, that is allowed here. And what is the eligible amount of issue of PDIs? For perpetual debt instrument in the foreign currency, the eligible amount is calculated higher of 100% of risk weight asset, 1.5% of risk weight asset, or total additional tier 1 capital. If RWA is 1 lakh crore, 1.5% of RWA is 1500 crore, and total additional tier 1 capital is 1200 crore. So what is the eligible amount? Higher one, that 1500 crore. Right? Then uh, here we can say, just that here we can say maximum overseas issuance limit. Not more than 49% of the eligible amount can be issued as foreign currency instruments and as rupee denominated bonds overseas. At least 51% must be raised domestically in the India. And why RBI put this 49% cap? Just to avoid excessive dependence on the foreign markets. To ensure domestic investor participation. So RDBs are INR bonds which are issued abroad. Forex risk is equals to investors. And what is the RBI permission date? 3rd of November 2016. It is used for additional tier 1, tier 2 and infrastructure. And what is the eligible amount? Higher of 1%, 1.5% of RWA or additional tier 1 capital. And overseas insurance cap is 49%. Clear? That is 49%. Now, some questions. Let's see some questions related on the concepts. What is the condition for an investment to qualify as foreign portfolio investment in a listed Indian company? What is the condition of an investment to qualify as FPI in a listed Indian company? So what is the answer according to you? See, I told you that the investment must be less than 10% of the post-issue paid-up equity capital on a fully diluted basis. Matlab, in easy words, in India, whether a foreign investment is treated as FDI or FPI, it mainly depends on how much ownership the foreign investor has in a listed company. If a foreign investor owns less than 10% of the company's equity, then it is treated as FPI. The moment the ownership reaches 10% or more, it no longer FPI, it becomes the FDI. So according to the option, the correct answer is the investment must be less than 10% of the post-issue paid-up equity capital or a fully diluted basis. Option B is correct. Is that clear? Now, next question. For which category of ECB is the MAMP 10 years? For which category of ECB is the MAMP 10 years? So, which answer is correct according to you? See, very simple answer is there. We know that ECB raised for working capital purposes or general corporate purposes. Means MAMP, that is minimum average maturity period, means when there is a minimum period, that is the minimum period for which the ECB must be borrowed, for which ECB must be borrowed. Right. So, as per the RBI rules, when an ECB used for working capital, when an ECB is used for working capital or any general corporate purposes, it is considered riskier and short-term in nature. So, to control the risk, RBI requires a longer maturity. So, MAMP is fixed here only for 10 years. So, the correct answer of this question is option B, which is ECB raised for working capital purposes or general corporate purposes. Now the next question, what is the purpose for which other person residents in India, including resident individuals, are allowed to hold the underlying shares? What is the purpose for which other person resident in India, including resident individuals, are allowed to hold the underlying shares? See, normally, whatever the persons are in India, they are not allowed to freely hold underlying shares. They are permitted to hold them temporarily and only to sell them. So, residents, including the resident individuals, they can hold the underlying shares, but only for the purpose for selling them and within 30 days from the date of conversion. So, here the thing which is correct, that only for the purpose of sale within 30 days from the date of conversion. Option B is correct here. Who can hold the underlying shares for a period of 30 days from a date of conversion of IDR into the underlying shares? Who can hold? See, whenever IDRs are converted into the underlying shares, right? Whenever the IDRs are converted into the underlying shares, person who are resident in the India, they are allowed to hold these underlying shares only on temporary basis. They can hold, but only for 30 days from the date of conversion. And what is the purpose? Just to sell them. So other person resident in India, including resident individuals. The questions are two, but they're asking the thing is different here. Now, what regulatory rules should be should issue the IDR comply with? What regulatory rules should the issue of IDR have to follow, have to comply with? See, IDR IDRs are issued by whom? Obviously by the foreign entities, right? IDRs are issued by the foreign companies, foreign entities. Why? Because they want to raise money from the Indian investors. And that's why two types of regulators are involved. First is Companies Rule 2014, sorry, because these ensures the foreign company is properly registered and following all the rules under the Indian company law. Next, we have SEBI, which basically ensures investor protection, proper disclosure, and fair issue practices in the Indian securities market. So, IDR issue have to follow both sets of rules. So, which answer is correct? Option C is correct. Both companies rule 2014 and Securities and Exchange Board of India Regulation 2019. So, option C is correct here. What is permitted under the limited two-way fungibility scheme? What is here permitted under the limited two-way fungibility scheme? See, under the limited two-way fungibility scheme, investors they are allowed for convert in both directions, but some restrictions are there in both directions, but some restrictions are there. American depository receipt, global depository receipts, they are underlying domestic shares. Conversion is there. For underlying conversion share, domestic share to ADRs are allowed. Means ADR, GDR are converted to the underlying domestic share. Underlying domestic share are converted into ADR and GDR. This two-way movement is why it is called two-way fungibility, and it is limited because it is allowed only within the approved limits. So both conversion of ADR, GDR into underlying shares and vice versa is permitted here. Now, what does two-way fungibility means? Simple. When the ability of converting ADR, GDR into the underlying domestic shares and vice versa. That is the meaning of two-way fungibility scheme. Important thing. So option B is correct here. What do GDR holders have the right to do with their receipt? What do GDR have the right to with their receipts? See, GDRs represents the ownership of shares of an Indian company, but they are traded outside the India, right? They are traded outside the India. A GDR holder has the right to convert the GDR into a fixed number of equity shares of the Indian company. This conversion right is the core feature of GDR that convert them into a specified number of equity shares of an Indian company. So option B is correct. What does the term foreign technology collaboration include? Foreign technology collaboration. Very simple. Foreign technology collaboration refers to the arrangements when when any Indian company get the right to use the foreign technology or any intellectual property. When Indian company use foreign technology and intellectual property, it specifically includes licensing agreements for franchise, trademark, brand name. These are treated as technology related collaboration because they involve transfer or use of technical know-how, processes, or the commercial technology. So the correct answer is here option B. Licensing for franchise, trademark, and brand name. And what does the meaning of repatriable in the context of foreign investment? Repatriable when the investment can be uh, taken outside the India. That means repatriation means when the investment can be withdrawn and transferred outside the India. Simple. These terms are very important. We must know the meaning of these terms. And then the last question for today. What is the primary requirement for an investment to be considered as foreign investment? What is the primary requirement for an investment to be considered as foreign investment? When, when an investment is called foreign investment, only when all the conditions are met. What are the conditions? First condition, it must be made by the person who is resident outside India. It must be repatriable. All the money can be taken outside the India. It is invested in capital instruments of an Indian company or in the capital of an LLP. So the correct answer of this question is option D. The investment must be repatriable basis in capital instrument of an Indian company or to the capital of an LLP.
Funding and regulatory aspects. All the things which are required to run a bank smoothly. CRR, SLR, LAF, NDS, STP, these all the important terms we are going to learn in today's session. So let's start with the class, and in last we will do some MCQs which are very important and which helps us in brushing up our concept. So let's start with the class. Here, first start with the reserve assets. What is the meaning of reserve assets? You know that these are the assets which are the compulsory reserves. These are those type of reserves which are compulsory and that bank have to keep to ensure liquidity, safety of depositors' money, control of money supply by the RBI. Liquidity, safety of depositors' money, control of money supply by the RBI. And we have two main reserve requirements in the India. Cash reserve ratio, statutory liquidity ratio. Now, what is the meaning of this cash reserve ratio? Very simple. Cash reserve ratio is that ratio in which minimum percentage of a commercial bank total deposit that it must keep with the central bank like RBI in the cash form. Minimum percentage of the commercial bank total deposits they have to keep with the central bank in the cash form. And the purpose of this CRR is just to control the liquidity in the banking system and to regulate the inflation. The main aim of this is just to control the liquidity in the banking system and regulate the inflation. Right? Now, if CRR is capped with the RBI in cash, so bank cannot use it for lending or investment. Higher CRR means less money for banks to lend, liquidity decreases, inflation control. And if there is lower CRR, that means lots of money to lend, liquidity increases and growth simulation. So suppose if CRR is 4% and bank has 100 crore in deposits, it must keep rupees 4 crore with the RBI. So what is CRR? CRR is the percentage of bank net demand and time liabilities that must be kept as cash with the RBI. Total deposit, minimum portion, some portion of total deposit that must be kept with the RBI in the cash form. Right? According to which section? Section 42, subsection 1 of RBI Act 1934. Section 18, subsection of Banking Regulation Act 1949. And what are the main features of this CRR? It have to be maintained only with the RBI, and it is maintained in cash form only. No interest is paid by RBI on CRR, and it is used by RBI to control the inflation and the liquidity. That are the features of the CRR. Currently, we have to maintain 4.50% of NDTL. So if bank NDTL is 1000 crore, CRR is 4.50 crore, 4.50%. So CRR must be maintained 1000 crore multiply 4.50%, that is 45 crore. That 45 crore have to be kept with RBI, and that cannot be used for lending as well as for investment. Right? Then what is the maintenance rule of this CRR? It must be maintained on average basis over a fortnight, like on 14 days period. Daily balance should not fall below 90% of required CRR. So if required CRR is 100 crore and balance must be maintained 90 crore. 1 day shortfall, 3% per annum penalty above the bank rate, and continuing default 5% per annum above the bank rate. This is the penalty if banks are unable to maintain the CRR. So obviously no bank is interested in violating these CRR norms, right? Then statutory liquidity ratio. What is the meaning of this statutory liquidity ratio? Statutory liquidity ratio, this is the percentage, minimum percentage of commercial bank net demand and time liabilities that must be maintained in approved liquid assets. Approved liquid assets. Approved liquid assets like cash, gold, approved government securities, and it's ensure banks have to maintain a safe and stable asset base to control the credit expansion. SLR is the percentage of NDTL that banks have to maintain in liquid assets. Right? Currently, 18% of NDTL is mandatory for the banks to maintain, and basically SLR is maintained by the banks with themselves, not with the RBI. CRR is maintained with the RBI, but SLR is not maintained with the RBI. Banks have to maintain themselves these SLR. Right? So if SLR is 18% and bank has 100 crore in deposit, it have to maintain 18 crore in approved liquid assets. Right? That is the thing for the SLR. Okay. So what is the difference between CRR and SLR? CRR is maintained with RBI. SLR is maintained by bank itself. CRR is maintained in cash only, whereas SLR is maintained in cash, gold, government securities. CRR is having no interest, but in SLR, government securities earns the interest. In CRR, it controls the money supply, but SLR ensure liquidity and safety. In CRR, current rate is 4.50%, but in SLR, the current rate is 18%. Right? Now, the most important thing, DTL, demand and time liabilities. What is the meaning of this demand and time liabilities? Very simple. Demand and time liabilities, where this refers total deposits of a bank that are either demand liabilities which can be withdrawn by the depositors anytime. Time liabilities, deposits that held for a fixed period and cannot be withdrawn before the maturity. These basically you can say that demand liabilities can be withdrawn by the depositors anytime, whereas time liabilities, deposits that held for a fixed period and cannot be withdrawn before the maturity, that are the time liabilities, right? So demand liabilities, you can take example saving account deposit, current account deposit, cash certificates, or which can be withdrawable at any time by the customer. But time liabilities have some example like fixed deposits, recurring deposits, deposits held for a fixed period. Banks cannot use these funds for lending until maturity without paying a penalty. So CRR and SLR both are calculated as a percentage of DTL, demand plus time liabilities. DTL represents the fund available to banks for lending and investment. DTL means all the money customers has deposited. With demand, withdraw anytime. Time liabilities are fixed for a period. So you can read here which is payable on demand by the depositor. Current deposit, demand portion of saving deposit, margin account, LC guarantees, overdue fixed deposits, outstanding DDs, MTs, TTs, unclaimed deposits, which can be withdrawn anytime, are called demand liabilities, and time liabilities are payable but after a fixed period. Like 1 year FD, time liability. Now some of the liabilities which are excluded from the CRR calculations. The followings are not included in demand and time liabilities for the CRR. Some are the things which are excluded from the CRR. What? Paid up capital and reserve, refinance from RBI, NABARD, SIDBI, net income tax provision, claims from DICGC, ECGC, bankers acceptance faculty, DRDA subsidy. These are not the customer deposits. These are not customer deposits. So saving here we can say whatever the calculation happen for CRR and SLR, it is based on NDTL as on the last Friday of second preceding fortnight. So if CRR for fortnight starts from 1st of February, then that means last Friday of early January the calculation are done, right? That is the calculation date for CRR and SLR. Now CRR and SLR for a current fortnight are calculated based on the NDTL of the last Friday of the second preceding fortnight. That means time lag of one fortnight, 14 days at least. Now, the most important, liquidity adjustment facility. What is the meaning of this liquidity adjustment facility? This is a facility which is provided by the RBI to the commercial bank. RBI provided this facility to the commercial bank so commercial banks can adjust their short-term liquidity mismatches. Commercial bank adjust their short-term liquidity mismatches. It obviously help the banks borrow or park the funds with the RBI just to manage the day-to-day liquidity. Right? This is a facility which is provided by the RBI to the commercial banks to adjust their short-term liquidity mismatches, and it obviously helps the banks or to borrow or park the funds with the RBI to manage the day-to-day liquidity. And there are some components of LAS. First component we have repo. Repo means repurchase agreement. That is repo. rate, which is called repurchase agreement. Bank borrow the money from the RBI by selling the government securities, but with an agreement to repurchase them after a short period. Short period is usually overnight. It used when bank needs the funds, when there is the liquidity deficit. So in the repurchase agreement, as the name saying repurchase agreement, banks borrow the money from the RBI by selling the government securities with an agreement to repurchase them after a short period. And it is used when bank need funds. Whereas there is one more term, that is reverse repo rate. What is the meaning of reverse repo rate? When bank lends money to the RBI. When bank gives money to the RBI, lending the money to the RBI. Why? By buying the government securities with an agreement to sell them back later. When the bank lend money to the RBI by buying the government securities with an agreement to sell them back later. It is used when obviously banks have excess funds. When the banks have excess funds, then this reverse repo rate is used by the banks. So LAF generally maintain short-term liquidity in the banking system. It controls short-term interest rates. It ensures smooth functioning of monetary policy. So if there is a liquidity deficit, means repo borrowing from the RBI, and if there is a liquidity surplus, reverse repo, that means lending to the RBI. Clear? So here you can read LAF is a main tool of RBI monetary policy, which is used to manage day-to-day liquidity, control short-term interest rates. RBI injects or observes the liquidity through the LAF. And what are the instruments under the LAF? Repo, where RBI lends money to the banks. Bank give government securities as collateral, used when bank face liquidity shortage. And overnight fixed rate repo is 0.25% of bank-wise NDTL. And tenure is generally one night. LAF repo rate, which meet daily liquidity mismatches. And variable rate repo, where the tenure starts from 7 days to 28 days. It is auction based. It provides medium term liquidity. And in system wide limit, 0.75% of NDTL of entire banking system. Now ECR is not used, LAF is used instead of ECR. So if a bank's NDTL is 40,000 crore and overnight repo eligibility is 0.25% of this 40,000 crore, so 100 crore is the answer. That is eligible amount. Is that clear? I hope the thing is clear here. Now RTGS, real time gross settlement. RTGS, this is a system for instant large value fund transfers from one bank to another. Instant large value fund transfers from one bank to another. It is real time because transfers are immediate here. Gross settlement because it's settled individually, not in batches. And the minimum amount is 2 lakh in the India. Minimum amount is 2 lakh. At least 2 lakh is the minimum amount of transaction that is possible in the RTGS. Right? So it used basically for large value interbank transfers. So it introduced in October 2004. Real time immediate settlement is there. Transaction by transaction happens. Everything is happen immediately. No paper required. Minimum amount is 2 lakh. So if customer wants to transfer 5 lakh via RTGS, money is credited instantly without waiting for end of day clearing. That is the meaning of RTGS. Now, Infinet, Indian Financial Network, Infinet, a communication backbone network for the banks in the India, which is run by IDRBT. Communication backbone network. And what is this IDRBT? Institute for Development and Research in Banking, which is basically a engineering training institution for the banking technology. So Infinet is a communication backbone network for the banks in the India. It is very secure, fast electronic communication happens between the banks and the financial institutions. It supports RTGS, NEFT and other electronic transactions. Right? And basically this is like the internet of banks in the India. So Infinet, developed by IDRBT, secure communication backbone for banks and financial institutions. What is the meaning of SFMS? Structured Financial Messaging System. Structured Financial Messaging System. A system which is used for standardized electronic messages in the financial transactions. This is a system which is used for standardized electronic messages in the financial transactions. So, like Swift is one of the most secure, popular method. It is used domestically in the India. Right? It is used domestically in the India. So, you can say that it supports the RTGS and NEFT messages, and also it ensures secure and standardized message formats for the transactions. Right? Okay. Now we can say that this SFMS, domestic messaging system, similar to Swift, but it is used in India, used for fund transfer and for authenticated messages. It used along with the Infinet. NDS, Negotiated Dealing System. What is the meaning of NDS? This is an electronic platform for trading the G-Secs. For trading the government securities and money market. All the money market instruments in the India. It is used by banks, primary dealers, financial institution. It is fully electronic, transparent and secure. It helps the RBI manages the liquidity and conduct the monetary policy operations. So NDS is simple, which introduced in February 2022. It is completely electronic platform for government securities, money market instruments, and here automatic electronic reporting and settlement happens here. Electronic auctions happens here. trading platform is, this is the trading platform for the government securities on the negotiated basis. Right? So here we can say that CRR and SLR, they are calculated on second preceding fortnight. LAF is the main operating tool of monetary policy. Repo, where RBI lends to the banks. RTGS is real time plus gross settlement. Infinet is the communication backbone, and SFMS is domestic SWIFT-like system. And NDS is government securities trading platform. Clear? So now NDS OM is anonymous screen-based electronic trading system for government securities, which is launched by the RBI in August 2005. It is an improvement over the earlier NDS, which was largely telephone based. And why was this NDS OM was introduced? Because earlier system problem, deal was done over the telephone. There is very lack of transparency, high operational risk is there, manual reporting delays are there. So NDS OM solved these issues by providing screen-based trading, anonymity, faster settlement, and STP. Now, anonymous order matching means where buyer and seller identities are not disclosed. It reduces counterparty biasness. Screen-based trading means all trades are done electronically, no manual or telephone confirmation needed, and telephone based trading on NDS still exists, but major volume shifted to the NDS OM. Right? Is that clear? Now, if I tell you some words about the NDS, it is a subset of NDS for anonymous order matching in the government securities. Trades are matched automatically, which is based on pricing and quantity. It ensures transparency and as well as efficiency in the secondary market. It is operated by RBI to allow the banks and investors to trade the GSECs freely. So, that is the meaning of NDS OM. And now straight through processing, STP. Straight through processing. Once a trade is executed on NDS OM, it automatically flows to the CCIL for clearing and settlement without manual intervention, which reduces error, delays, operational risk. So, a system where financial transactions are processed electronically without manual intervention from start to finish. It reduces any type of error, delays, and operational risk. It speeds up the settlement of payment, trade, or transfers. It is basically used in banking, stock market, and obviously in the Forex settlement. So a customer here transfers money via RTGS. So payment automatically moves from sender to beneficiary bank and credited instantly without any manual handling. That is the concept of STP. Now, Forex Clear, Forex dealing system. Forex Clear is a foreign exchange dealing and clearing system which is developed by the CCIL. It is a foreign exchange dealing and clearing system developed by the CCIL. And what are the transactions covered? US dollar INR cross currency transactions. What is the benefit of this foreign exchange clear? It reduces the settlement risk, central and counterparty guarantee. It improves efficiency and transparency in the forex market. If two banks they enter into the US dollar INR deal, FX Clear act as a middle party. It ensures both currency legs are settled safely. That's why we have two most important depository institutions, NSDL, CDSL. Depositories hold the securities in the electronic demat form. And what are the major depositories in the India? NSDL and CDSL. National Securities Depository Limited, Central Depository Services Limited. Now, delivery versus payment. What is the meaning of this delivery versus payment? A settlement mechanism in the securities trading where delivery of securities occurs only after payment is made. A settlement mechanism in the securities trading where delivery of securities occur only after the payment is made. It eliminates settlement risk. It ensures simultaneous exchange of money and securities. It is used in stock market, government securities, and as well as corporate bond settlements. So if you buy the government bonds, the bonds are credited to your account only after your payment is received. So DVV is a safety and trust. Think of it as pay first and get the goods simultaneously. So securities are delivered only when payment is made. And payment is made only when the securities are delivered. So obviously it eliminates the settlement risk. Securities and funds are cleared by their respective clearing corporations. It ensures safe and guaranteed settlement. Now, NEFT and online payments. NEFT, obviously it is National Electronic Funds Transfer, introduced by the RBI to enable same-day electronic fund transfers. And it is used for interbank and intra-bank remittances. It is electronic system, batch-based, not real-time, and it is available 24/7 days. And no minimum amount required as well as no maximum amount required. Now we have core banking solutions. Core banking allows customers to access the account from any branch, transfer the funds anytime, anywhere. The benefits of this: instant internal fund transfer, no dependence on branch location. It improved the customer convenience. So obviously customers transfer money from Delhi branch to Mumbai branch of same bank, instant credit through the CBS. That is possible with the help of CBS. And why the regulation is needed? Because RTGS, NEFT, NDSOM, Forex clearing system, payment system have become complex and systemic risk sensitive. So it is constituted by the RBI. It operates as a subcommittee of RBI Central Board, and highest level oversight body is that body which regulates all the payment system, supervise the clearing and settlement, and ensures safety, efficiency, and stability. So NDSOM launched in August 2025. It provides anonymous order matching. Trades flow directly to the CCIL. FX clear is for Forex transaction. NEFT enables same day electronic transfer. RBI regulates payment system through a special board. So what are the changes were made to the limits of the CRR as per the amendment in the Act of 2016? So try to give the answer of this question. That what is that change? So the correct answer is here, to align with the basically we know that both the minimum and maximum CRR limits were removed, which gives the RBI discretion in stipulating the CRR. The Reserve Bank of India Act 2006 removed both the statutory minimum and maximum limits on the CRR, and the amendment empowered the RBI with full discretion to prescribe CRR as required for monetary policy management. So the option B is correct here. What are the main components of demand and time liabilities? Main components of demand and time liabilities. Demand and time liabilities of a bank primarily include its deposit liabilities and certain other liabilities. So demand deposits, time deposits, overseas borrowing, foreign outward remittances, in transit, and other demand and time liabilities. So the correct answer is option D here. What is the exemption criteria for maintaining the CRR for minimum eligible credit and outstanding long-term bonds? As per the RBI, banks are allowed exemption from CRR maintenance to the extent to the lower of minimum eligible credit and outstanding long-term bonds. And obviously which ensures that CRR exemption is capped conservatively and linked to the both actual lending and the amount of long-term resources which are raised. So the correct answer is option B here. And which subsidy is not considered for NDTL stipulation? C. The answer is whatever the subsidy released by the RBI for refinancing purposes. Means for the purpose of NDTL computation, certain government and institutional subsidies capped in designated accounts, these are excluded from the NDTL. Why? Because whatever the subsidy released by the central state government capped in 0% fixed deposit account. NABARD subsidy under the investment subsidy scheme for the rural godowns, and the DRDA subsidy capped in subsidy reserve fund account in the name of basically in the name of SHGS, basically funds released by the RBI for refinancing purposes. They are not related or treated as subsidiaries, and therefore they are not eligible for the exclusion from the NDTL. That's why the option D is correct here. And what is the role of reverse repo in the LAF? Under the LAF, repo, that RBI lends funds to the bank against government securities, which means injecting the liquidity. And reverse repo, where RBI absorbs the liquidity by accepting the deposits from the banks against government securities. So the correct answer is option B, accepting the deposits from the banks. So what is the purpose of variable rate repo introduced by the RBI? Variable rate repo. The variable rate repo, term repo, which was introduced by the RBI to inject the liquidity for pre-announced tenors such as 7, 14 and 28 days through auction-based variable rate mechanism, which obviously helps the banks in managing short-term liquidity mismatches beyond the overnight needs. So the correct answer of this question is option D. To provide the liquidity for specified periods, 7 days, 14 days and 28 days. Option D is correct here. How does the LAF framework limit the lending and borrowing activities of a bank in the interbank market? Because under the LAF framework, RBI places prudential limits on banks' access to repo and reverse repo operation to prevent over dependence on central bank liquidity. These limits operate as ceilings on both daily and average borrowing lending in the interbank market via LAF. So the correct option is option B. It imposes a ceiling on both average and daily lending and borrowing activities.
We are going to learn about treasury risk management. Treasury risk management means just to identify, measuring and monitoring the risk, right? Because treasury deals with the forex operations, treasury deals with the exchange trading, treasury deals with the buying and selling of the securities. So that's why treasury is one of the most important concept in our life. Now, why this treasury risk management is important? Treasury risk management is important mainly for the two reasons. First reason, market-based nature of treasury. Treasury always earn profit by taking the advantage of that market movements. If market are uncertain, risk is present in every treasury activity. Suppose if a bank buys dollar expecting dollar to rise, but instead the dollar fails, the bank immediately suffers a loss. Second reason, balance sheet management responsibility. Treasury is also responsible for managing the risk which is created by other departments, especially market risk on the balance sheet. If the loan department gives many fixed rate loans, Treasury has to manage interest rate risk which is arising from any other loans. So Treasury is very crucial for our banks, for our financial institutions, right? Okay. Now, the thing is there that why the bank management is highly concerned about the treasury risk. Why bank takes treasury management too much serious. The thing is there are three major regions. First, we have high leverage. First is high leverage. What is the meaning of high leverage? High leverage means treasury operate with very low capital but handles very large transaction volumes. Small market movements also lead to very large profits or losses. Example, if a minor interest rate change and that interest rate change can cause huge valuation loss on the government securities which is held by the treasury. Then the second region is large transactions at treasury. Means large transactions at treasury means where the treasury transactions are large in size. So decisions are taken quickly by the few dealers. Example, if a wrong Forex trade decision is done by the chief dealer, that can result in massive loss within the minutes. And third major region is here the losses materialize quickly and these are irreversible. Means treasury transactions are large in size. We know that. So treasury losses also occurs in the short term and once a deal is confirmed, it cannot be reversed. So if the bond price fall after purchase, the loss is immediate and cannot be corrected. So these are the three major regions. That's why bank management is highly concerned about the treasury risk. Is that clear? Now, systemic risk and unsystemic risk, two important risks in which systemic risk is dangerous than unsystemic risk. Why systemic risk is dangerous? Because in the systemic risk, what happens when any bank fails? That impacts the entire economy. And that risk is unmanageable, that risk is uncontrolled, and the loss are huge in this. But unsystemic risk is related to single borrower or a single group sector, and unsystemic risk is manageable and controllable. Usually, unsystemic risk is managed through the diversification. So, systemic risk affects the entire market or major segment of a market. It cannot be eliminated through the diversification. Suppose increase in RBI policy rates impact all bonds and interest sensitive instruments. Whereas unsystemic risk, this risk is related to the specific investment or counterparty and can be reduced through the diversification. So suppose if one company bond default, that affects only that bond, right? So that is the difference between systemic risk and unsystemic risk. Systemic risk is dangerous, unsystemic risk is not that much dangerous. Now, funding risk or liquidity risk in the treasury. Treasury always face liquidity risk because Obviously, every settlement requires availability of funds on the due date. Treasury faces liquidity risk because every settlement requires availability of funds on the due date, and failure to arrange funds for securities settlement that may result in default and as well as penalties. Now, control measures for treasury risk. What are the control measures? How banks are control these types of risk? Treasury risks are controlled mainly through supervisory and control mechanisms, which are classified into three categories: organizational controls, exposure ceilings, and trading position limits and stop loss limits. So, what are the control measures for treasury risk? These are controlled mainly through the supervisory and control mechanisms, which are classified into these three categories: organizational control, exposure ceiling, trading position limits, and stop loss limits. Let's explain that. What is that? Now, the thing is there, what is the meaning of that organizational controls in the treasury? Means everything is proper, everything is according to the rules and regulation, and treasury is divided into three functional units. Front office, where the front office executes treasury transactions with the counterparties. Foreign exchange trading, securities trading, money market lending and borrowing. And it is headed by chief dealer. And front office is considered as profit center for the banks. If a forex dealer buys dollars from another market, that must be based on expected market movement. Now, back office. Front office, middle office, back office. Back office is generally, we can say that that ensures everything is according to the compliance and regulations. Everything is according to the compliance and regulations, and accuracy is there. They monitor exposure and position limit. They do confirm and settlement of deals. They ensure that everything is according to the rules and regulation of the RBI and manage the policies. And there are accurate accounting of transactions. So if a dealer breaches the position limit, the back office flags and report it immediately. That is the work of the back office. Then we have middle office that focuses how to do the risk management, how to do the reporting. This monitors the market risk. This ensures everything is according to the board approved policies. It generates the management information system reports and as well as manages the liquidity and investment risk. So, middle office always calculate all the potential losses under the adverse market condition and also give report to the top management always. That is the work of this office. Now, we have stop loss limits. Uh, First, let's discuss about the stop loss limits. Stop loss limits basically define the maximum loss. That maximum loss which treasury is permitted to take. This stop loss limit basically prevents from unlimited losses when market moves adversely in wrong direction or fluctuations are there. Once these losses reach the stop loss limit, positions must be closed immediately. All the positions are closed immediately. And if the losses touch the approved stop loss limit, that all the open positions are closed. So that is the meaning of stop loss limits. Maximum limit, maximum loss treasury can take. And what are the internal controls in the treasury? Internal controls directly restrict dealer activities to control the risk. Internal control directly restricts the dealer activities to control the risk. And there are three main internal controls. First, limits on the deal size, that obviously that much risk or the limit is there for a single dealer. And why this type of limit is there? Because to prevent from any extra exposure only on one trade. So a dealer is permitted to transact only up to specified amount per deal. Then limits on open positions. Open position refers to unmatched buy or sell positions that expose the bank to the market risk. Open positions that buy or sell positions, unmatched buy or sell position that expose the bank to the market risk. And position limits are fixed currency wise and in aggregate rupee terms. So if purchases exceed sales in a currency, the unmatched amount is an open position and must remain within the approved limit. Then stop loss limit is clear. Now the exposure ceiling limits. What is the meaning of exposure ceiling limits? Um, Exposure ceiling limits. We can take the example also. Let's understand the concept first of the exposure ceiling limits. See, these are the fixed to protect the bank from credit part risk or counterparty risk. From the credit risk or the counterparty risk which is arising out of treasury operations. In treasury businesses, bank deal with other banks, financial institutions, and brokers. And there is always a risk that the counterparty may fail to meet its obligation. Credit risk in treasury is mainly divided into two parts. Default risk, when the complete borrower is defaulted completely. Settlement risk, when one party complete their part of obligation but does not receive the counter value from the counterparty. So exposure limits are fixed in such a way that the size of treasury operations is spread across many counterparties. And this ensures that risk is not concentrated on a single bank or institution. We can take the example on this exposure ceiling limits. Exposure ceiling limits like uh, suppose if a bank places all of its funds with only one counterparty. Now, failure of that counterparty can cause huge loss. Exposure limit prevents such type of concentration. Exposure limits are also fixed for foreign exchange brokers and money market brokers. So treasury business is not concentrated through a single borrower. If all the forex deals are routed through only one broker and that broker commits fraud or fails, so bank is on the high risk. So that's why brokers limits are fixed always. Right? That is the reason the broker limits are fixed. Okay. That is the exposure ceiling limit. Market risk is what? Market risk when there is an unfavorable conditions in the market that creates problem to the bank, that creates loss to the bank, that is called market risk. So Liquidity risk when there is no enough cash available and cash flow mismatches. This happens when funds are required urgently but are not available. Suppose the treasurer borrow money in the call money market for 1 day and uses that money to purchase a 5-year government security. So mismatch is there. Using the short-term funding for long-term fund. Using the short-term funds for the long-term funding that will create the liquidity risk. Interest rate risk, simple, refers to the risk of loss due to changes in the interest rates. And it may arise in two ways. Either interest cost on liabilities increases or interest income from the assets decreases. So if a bank has given a long-term fixed rate loans and interest rate rise, the bank will have to pay higher interest on deposit but will continue to earn interest on the loans. That will reduces the profitability. That thing will reduce the profitability. Currency risk, exchange risk, rate risk, which basically arises due to the fluctuations in the foreign exchange rates. That currency risk is closely related to the interest rate risk because if any change is there in the interest rate, that obviously influence the exchange rates. Right? Okay. Now, risk measures value at risk and duration. What is the meaning of this? To manage the market risk, Treasury always use quantitative risk measurement tools such as value at risk and duration, right? And what is value at risk? Value at risk is a statistical measure that estimates the maximum possible loss a portfolio can suffer over a given period of time, right? Value at risk basically measures the extreme loss situations for the bank, maximum loss. What a bank can suffer, maximum. It questions the answer that how much can be lost in the worst case within a given time period. So, duration is a measure of interest rate sensitivity of an asset or liability. Duration is always expressed in years and widely used in investment and treasury management. Right? Okay. Uh, Now, that is clear that what is value at risk, one of the most important model, which tells about the extreme loss. Right? Now, let's learn about what are the derivatives and what are the use of derivatives. What are the meaning of derivatives and what are the use of derivative? We know that derivatives are the financial contract whose value is derived from an underlying asset such as interest rate, foreign exchange, securities, or commodities. derivatives are widely used in treasury to protect against the market risk. They are also used to manage balance sheet risk under the asset liability management. If a bank expecting interest rate to rise may use interest rate swaps or future to protect itself from loss on its bond portfolio. So if a bank with foreign currency exposure that may use forward contract to hedge exchange rate risk. So that's why derivatives are used to manage the risk management. And that is most important thing. Now, let's do some questions related to this chapter. First question is, how is the risk in loans different from the treasury risk? So tell me the answer of this question, that how the risk in loans different from the treasury risk. See, we know that loan risk means credit risk. The bank's maximum loss is limited to the outstanding principals and also unpaid interest. Treasury risk is largely market risk, and due to price volatility, leverage, and derivative, losses can be theoretically unlimited. So that's why loan risk is limited to the principal and interest, while treasury risk is unlimited. So that's why A option is correct here, right? Loan risk is limited only principal or interest is not paid, but treasury risk is unlimited. Now, why are traders generally not allowed to hold open positions for a long time in treasury activities? So tell me the answer here. Okay, I'm trying to put the timer. Okay, so what is the answer here? Simple. How can we say that treasury markets are highly volatile? The longer a trader holds an open position, the higher the exposure to the unpredictable price movements. Right? So, bank impose position limits, mark to market losses that can increase over the time. Unexpected events then can sharply move market. So traders are encouraged to just square off the positions quickly. That's why, to reduce the market risk exposure. So here we can say, to minimize the impact of risk is the correct answer here. So how the treasury risk primarily managed? How the treasury risk is primarily managed? See, simple, we know that whatever the treasury activities are there, they carry the high market risk. Whatever the risk is, high market risk, that risk is related to Forex risk, equity risk, derivative risk. So these risks are primarily managed through the strong internal controls and as well as supervision. And what type of supervision? Obviously, by doing the stop loss limits, value at risk, and continuous monitoring. So, there are, we can say, some supervisory methods are also there, some conventional methods are also there. So, the correct answer is through conventional control as well as supervisory measures. Option B is correct. Now, on whom are the limits imposed in the context of internal control for treasury risk management? See, in treasury operations, risk limits are imposed directly on the dealers who trade in foreign exchange, money market instruments, bonds and securities, derivatives, because no single dealer can take excessive risk. Losses always remain with acceptable boundaries. So the correct answer is here. Option C. Dealers trade in foreign exchange and the securities. Option C is correct here. Why are the trading limits imposed by the management only in the Treasury Department? Why? Why? Why the trading limits are there? Can you tell the answer? So simple answer is there because treasury markets they can move suddenly and obviously sharply, very sharply. So management imposes trading limits to ensure that if market turn adverse or not, losses always stay within the bank risk appetite. No single trade or dealer can cause here any type of disproportionate change. Bank capital and earnings are always protected. So what are the common limits includes? Position limits, stop loss limits, dealer wise limits, and value at risk limits. So the correct answer is here. Why? To avoid or contain losses in adverse market condition. Option C is definitely correct here. Now, what is the potential issue with holding and open positions when the treasury buys US dollar 1 million with the intention to sell when the US dollar appreciate against the rupee? See, here, if suppose treasury buys US dollar 1 million, US dollar 1 million, expecting the US dollar appreciate against INR. If US dollar appreciate, treasury sells at a higher rate on profit. If US dollar does not appreciate, treasury sells at the same or lower rate, which is a loss condition. So the risk lies in the expectation, not materializing. So option C is correct that there is a potential loss if the US dollar does not appreciate. Then what do stop limit represent in the context of controlling trading operations? And I told you about the thing. that stop loss limits advantage. I told you that stop loss limit means that tells about the maximum loss that the treasury can incur. Right? Now, treasury must stop or positions must be squared off. Further losses are prevented. Discipline is enforced during adverse market movements. So, effectively, it marks the endpoint beyond which trading operations cannot continue. So, the correct answer is by an endpoint for trading operations. Option B is correct. What is default risk in treasury? And the bank lends in the money market. When the bank lends in the money market. See, when a bank gives loan to the money market, it faces default risk. Means counterparty bank may not repay principal or interest on maturity. This is essential credit risk even though tenors are short. So we can say when the risk the borrowing bank may fail to repay the amount on the due date, that is the default risk. Default risk means no chance of recovery, complete loss, no chance of recovery of any amount, complete loss. Now, why it is not always possible to achieve the DVP mode in the transactions? DVP mode in the transactions. DVP means delivery versus payment. What is the meaning of delivery versus payment? Means securities are delivered only when payment is made simultaneously. In practice, this is not always achievable because of different time zones between countries, different settlement system and operating hours, cut-off timing of payment and securities system. These physical and operational constraints can prevent perfectly simultaneous exchange. So simple due to physical barriers such as different time zones. So that's why it is not always possible to achieve the DVP mode in the transaction. So option C is correct. What are derivative products and what can be directly negotiated and obtained from the banks and investment institutions known as? What are the derivative products that can be directly negotiated, that can be obtained from banks and investment institutions, such as, see, we know that derivative products are those products which are directly negotiated, directly negotiated between the banks, between two parties, such as banks, financial institutions, corporates, and these types of derivatives are called OTC, over the counter derivative. What is over the counter derivative? These are the customized contracts. They are traded but outside the exchanges. They carry the counterparty risk. Example, forward, swap, OTC options. That is the correct answer. That means option C is correct here. where over-the-counter products is the correct answer. What is the primary difference between larger banks and other banks regarding the use of future trade on exchanges? Larger banks. Larger banks and the other banks, which are regarding the use of futures traded on the exchanges, basically. And I hope that you know about the future. If you know that, can you tell me that what is the meaning of future derivatives? Future, as the name is future, these are the standardized financial to buy and sell any agreement, underlying assets, sorry, like commodities, stock indices. Prices are determined today, but settlement happens on future date, right? So usually larger banks, they are market makers, and that's why large banks, they can cover any type of open positions in the future, and these open positions are protected using the exchange trade future. So the correct answer is here. Larger banks are the market makers and cover their residual positions in the future. Option B is correct here. How does a forward purchase contract protect the importers? How does a forward purchase contract protect the importers? See, when an importer has to pay the foreign currency in the future, the risk that are stay in the rupee may depreciate, which makes the imports more expensive. So a forward purchase contract locks the exchange rate today and protects the importer if INR depreciates in the future. So that's why we can say, by protecting against the depreciation of the rupee. Option D is definitely correct here. So let's see the last question for today. That how is the forward rate related to the spot rate? How is the forward rate is related to the spot rate? See, futures are the standardized contract. Forward rate is from the spot rate, but it is adjusted for the interest rate differential between the two currencies. If the forward rate is higher than the spot rate, then it is at a premium. But if spot rate is greater than the forward, that is the condition of discount, right? So forward rate is not independent of the spot rate, or nor it is always equal. So the correct answer of this question is option C, that the forward rate is either at premium or at discount to the spot rate.
Derivatives and treasury. Many bankers feel derivatives are dangerous or too technical. But I want to tell you clearly, in exams, derivatives are not tested for mathematics. They are tested for concept, purpose and RBI guidelines. So today we will learn derivatives like a story, not like a formula. So hello everyone, welcome here. I hope that you all are fine and doing well. Today we are going to do derivatives and treasury. So let's understand our concept number 1, derivatives and the role of treasury. Derivatives and role of treasury. Then you have to give answers after listening the concept. So imagine there is a very large Indian company has taken US dollar loan. Every month the company worries. What if US dollar become costlier? What if interest rate increase? What if cash flows become unstable? Now imagine a bank treasury sitting like a risk factor for the bank and its clients. What the treasury says? Treasury says, don't worry, I will transfer your risk to the market using the derivatives. That is where derivatives are born. Derivatives are the financial instruments whose value is derived from an underlying assets. Derivatives are the financial instruments whose value is derived from an underlying assets such as currency, interest rate, bond, commodity. Bank treasury uses derivatives mainly for 3 purposes. Risk management, where they manage all the asset liability management risk, where they manage interest rate risk, where they manage exchange rate risk. Client requirement, especially for corporate customers. Hedging the Forex and interest rate exposure. Right. And third one is trading purpose. Taking trading positions, treasury profit generation is there. So derivatives are derived value instruments and treasury functions, risk management, client service, trading. It focuses on ALM risk and hedging versus trading. Right? So what is the primary use of a derivative by a bank? Treasury is to what is the correct answer according to you? So here simple, treasury mainly uses derivatives for the risk management, client hedging and trading, not for replacing loans or avoiding regulations. So which option is correct here? Directly we have the correct option, managing financial risk and client exposures. So option B is correct here. Now clear with the concept of derivatives? Now let's understand the second concept. Then you have to give the answer here. Okay. Suppose a corporate customer comes to bank and says, I need a US dollar INR contract for 37 days for US dollar 3.75 million with special settlement terms. Bank says, yes, we can customize it exactly for you. This is called OTC derivative. Now imagine other person wants to trade US dollar INR like shares on a screen with standard size and daily margin. And that is exchange traded derivative. So what is the over the counter derivative? Which is privately negotiated, which is offered by the authorized banks, which customize the contract amount, date and terms. Bank quotes the price with the margin and also Here the counterparty risk exists. And what is the meaning of exchange trade derivatives? These are traded on recognized exchanges. Standardized contract size is there and maturity is there. Transparent screen-based pricing is there. Exchange becomes the counterparty, and there is daily margin system which eliminates the counterparty. So if I say that what is the difference between OTC and this exchange traded derivatives. So simple, OTCs are the bank negotiated and exchange traded derivatives are based on happens on the exchange, right? Then in this, contract is customized according to the need of the client, but in exchange contracts are standardized, right? Then pricing here in the case of OTC quoted by the banks, but in exchange price are transparent, visible for everyone, right? Then here in the margin, we can say margin is in the case of OTC is banks discretion or banks ability, but in exchange traded derivatives there is daily exchange margin, right? In the OTC counterparty risk is present, but in exchange party counterparty risk is not existed. And why OTC is used? For hedging, but in exchange it is used for trading and speculation. So that is the difference between OTC and exchange. Now the thing is there that OTC means customized, bank negotiated. Exchange traded means standardized and transparent. Counterparty risk is available in the OTC, right? Or next, margining system is there, right? So the answer of this question, now you have to tell me. I told you the concept. What is the answer according to you? Tell me fast. Simple, yes. OTC derivatives are customized and negotiated directly with the banks, unlike standardized exchange contracts. So the correct answer is here option C. OTC derivatives are customized contract. Which option is correct? Option C is correct. OTC derivatives are customized contracts. Now let's see the third question. Future contracts are described best as. Now future contracts. Let's see the concept here, which I am going to tell about types of derivatives. Types of derivatives means forwards, futures, options, swaps. These are the types of derivatives. Now types of derivatives, I want to tell you a story here. See, there is a businessman that wants certainty, right? Sometimes he wants certainty without flexibility. When he wants certainty without flexibility, that is called forward. Sometimes he wants flexibility with protection, that is option. Sometimes he wants market trading, that means futures. And sometimes he wants cash flow exchange, which is called swap. So all derivatives are there. All the types of derivatives are there in the market according to the need of the clients. So here, if I talk about the major types of derivatives, there are 4 types of derivatives are there, which are major types: forward contract, options, swaps and futures. Future is a standardized form of forward. Everything is same in future and forward, but future is standardized type, but forward is customized type. So 4 types of derivatives which are important: forward contract, options, swaps and future. Now What happens in swaps? Swaps are generally means cash flow exchange. What happens in forward and futures? Forward and futures. When when two parties agreed on same terms and condition, they do deal today, but they set the price today and do the settlement after 30 days or after a prescribed period of time according to the terms and conditions which are agreed between them, right? So basically future contracts are best described as here. Which answer is correct? Yes. Always remember this thing, that future contracts are standardized contracts and that forward contracts are customized contracts. These contracts are customized according to the needs of the customer, according to the demand of the customer. So that is the biggest difference between future contracts and forward contracts. So that's why future contracts are best described as exchange traded standardized forward contract. Option C is correct here. Got it? Okay. Now you got it that how many types of derivatives are, what is the meaning of derivatives. Now here, forward contract is idle for which objective? Forward contracts are idle, but for which type of objective? So try to see that what is the meaning of forward contract. See, I am going to tell you. Forward contract. Forward contract means when there is the agreement to buy or sell a foreign currency. When there is an agreement to buy or sell foreign currency on a future date at a fixed exchange rate. Listen carefully. Forward contracts are the agreement to buy a foreign currency on a future date at a fixed exchange rate, and here execution is mandatory and it provides zero risk hedging. There is fixed rate, future date, obligation to execute and zero risk hedging. So a forward contract is idle for which objective? Obviously for hedging, but with zero risk. Hedging is like protection with zero risk. So option C is correct here. Right? Now, which option is unique to option contracts? Option contracts here, the fourth option is interest income. Okay, option D is interest income. Which option is unique to the option contracts? Which option is unique to the option contract? So let me tell you about the option contract. Suppose you pay a movie ticket. Now you have to right to watch, but if you don't go, no penalty is there. The ticket fee is like option premium. It is your choice. If you buy a ticket, it's your choice. You do want to go or not. That ticket fee is like option premium. So now option contract, buyer has a right but no obligation. Buyer has the right but no obligation. Seller has obligation and premium is paid upfront. So call option is right to buy and put option is right to sell. So in forward is mandatory, option is optional. In forward there is no premium, in option premium is payable. In forward there is a fixed rate, but in option best of Strike or market price? Forwards are simple, but options are flexible. Right, but no obligation? Option. Call, buy, put means sell, and there is an option premium. So which feature is unique here? Obviously, upfront premium payment is the very unique thing is here. Upfront premium payment. Is that clear? Now, let's talk about futures now. Future contracts are primarily used for. Future contracts are primarily used for. See, let's see the example for the futures. Suppose there are the stock traders who buy and sell the currencies. They trade US dollar INR like shares every day, right? They are doing trading of US dollar and INR every day. They don't want delivery. They want only the price difference. That is called future. Future contracts are standardized contract. They are traded on exchange. They are fixed price, fixed rate is there, and they are mostly cash settled. So they are exchange traded, they are standardized, the daily margin is there, and cash settlement is there. So future contracts are primarily used for, yes, for trading and as well as for speculation. So option B is correct here. Which option is correct? Trading and speculation. FRA. FRA is differ from IRS because FRA covers what is the meaning of FRA? FRA is forward rate agreement. IRS is interest rate swap. Forward rate agreement is the full form of FRA, and IRS is related to interest rate swap. Now there are two borrowers who sit together. One wants fixed rate, one wants floating interest. They exchange their cash flows. There is no principal charges, hence physically. They just swap their cash flows. That is called swap. When the exchange of cash flows happens, that is called swap derivative. Interest rate swaps are the example of interest rate flows. Interest rate flows, and it is based on notional principle. Right? It is based on notional principle. Now the thing is there that what is the meaning of that notional principle? What is the meaning of notional principle? So notional principle or notional amount is that face value of financial derivatives like interest rate swap, future contract, which used solely individually to calculate the interest or cash payments. They are not for the actual exchange of principal, and they determine the size of the position, and while it dictates the interest flow, it remains untouched by the parties which are involved. So that is the notional principle, and interest rate swaps are based on notional principle. But forward rate agreements, they are single future interest payment is there. In IRS, there is multiple payments. Currency swap is completely depends on the exchange of cash from the different parties. Right? So we can say there are three types of currency rate swaps: principal only swap, coupon only swap, and third one is principal plus interest swap. Principal only swap, coupon only swap, and principal plus interest swap. Right? So why this FRA differs from the IRS? Because FRA covers what? Yeah, simple answer is there that according to the option, because of single future interest payment. In IRS there are there is multiple payments. So which option is correct? Option C is correct. Right? Now, next question. ISDA Master Agreement is required mainly to. ISDA Master Agreement is required mainly to. What is this ISDA agreement? ISDA Master Agreement. So let me tell you about the ISDA Master Agreement. Actually, this is the agreement which is standard or globally recognized contract for over-the-counter derivatives. And ISDA full form is that International Swaps and Derivatives Association. They govern the transaction like swaps and options, and they basically establishes a single unified agreement for all the trades which happens between the two parties, which allowed them to which helps them to reduce the credit risk and also the standardized legal terms. So suppose RBI acts like a strict referee, right? So it allows derivative but only with rules and documentation. RBI issued comprehensive guidelines on derivatives. RBI which issued comprehensive guidelines on derivative. ISDA Master Agreement is mandatory. Documentation stages are ISDA Master Agreement, Schedule and Trade Confirmation. Only those corporate who have board approved risk policies, they can use the derivatives. And bank have to follow suitably and appropriateness policy. So ISDA Master Agreement, suitability policy, RBI derivative guidelines and risk management policy. So ISDA Master Agreement is required mainly to what? Standardized derivative documentation. So option C is definitely correct here. Got it? That is the correct answer. Okay. Now, next question. FBIL is responsible for. FBIL is responsible for. What is the meaning of this FBIL and benchmarks? FBIL and benchmarks. So FBIL and benchmarks. See, simple. Market always needs a trusted referee for the rates, and FBIL plays that role. FBIL plays that role. Right? How? FBIL is the joint venture of FIMDA, of FEDI and IBA. This is the joint venture. Now, what is the work of this FBIL and what is this? So, you can say that this is a financial benchmark India Private Limited that basically a very good organization, important organization in the India's financial market, which are responsible for developing and administrating the benchmarks such as interest rate, currency rates. That is the work of the FBIL. Right? Now, FBIL publishes the benchmark like MIBOR, options volatility, certificate of deposit rates, IBA, that is the work of the FBIL, right? So uh, why this FBIL is responsible for? This is obviously responsible for benchmark rate publication. Option C is correct here. Which option is correct? Option C is correct. Got it? Now, derivatives are called derived instruments. Why? Derivatives are called the derived instruments, but why? What is the answer according to you? Now you are clear with the term derivatives. Very simple answer is there. They are called derived instruments because their value is derived from the value of an underlying asset. Underlying asset means the price of a derivative depends on the performance of an underlying entity such as stocks, bonds, commodities, currencies, interest rates, or market indices. So which option is correct here? Simple. Derivatives do not have any type of independent value. The value is derived from an underlying asset such as foreign currency, interest rate, bonds, commodities. For example, a US dollar INR forward contract get its value from the US dollar INR exchange rate. That's why they are called derived instruments. That's why they are called derived instruments. So which option is correct here? Option B is correct. Their value is derived from an underlying asset. Which of the following is most effectively managed by using the derivative? Which of the following risk is that? Which option is correct? So let me clarify that derivatives are designed. But why? Just to manage the market risk. Because market risk happens when the factors changes in the market and that factors become the cause of loss. So it includes exchange rate risk, interest rate risk, and price risk. Operational and legal risk are managed through internal controls and through the rules and regulations, but not by the derivatives. So which option is correct? Simple here, market risk is the correct answer. Option C is correct answer. Great. Got it? Why does OTC derivative contract involve counterparty risk? What is counterparty risk? When two parties enters into the agreement, one party fulfill their part of obligation, but another party is not unable or fails to fulfill their obligation. So why do the derivative contracts involve the counterparty risk? Which option is correct here? So let me tell you. See, we know that OTC derivatives are privately negotiated contracts between the two parties, bank and client. If one party fails to honor the contract, the other party suffers a loss. So there is no exchange acting as a guarantor. Counterparty risk exists here. So which option is correct? Simple. We can say the correct option is option C because settlement depends on the financial strength of the counterparty. Option C is correct here. Now, which feature makes exchange rate derivatives safer than OTC derivatives? Which feature makes the exchange traded derivative safer than OTC derivative? Simple. In exchange trade derivatives, exchange becomes the counterparty and there is daily M2M settlement is done. Mark to market settlement is done. What does this term means, mark to market? Mark to market, generally it is a valuation method that adjusts the value of assets and liabilities to their current fair market price. They reflect real-time market changes, which is crucial for transparency in the accounting, which is managing risk in trading and determining daily net asset value. It shows profit or loss as unrealized gains or loss on a daily basis. So, in this, we can say margins are collected daily. This eliminates the counterparty risk, which make them safer than the OTC derivatives. So, which option is correct? Simple, we have daily margining and clearing by exchange. Option C is correct. Next question. A forward foreign exchange contract creates which type of obligation? A forward foreign exchange contract creates which type of obligation? Simple answer. In a forward contract, both buyer or seller, they have to execute the contract at maturity, irrespective of market movement. This mandatory nature makes forward suitable for zero risk hedging but inflexible. For zero risk hedging but inflexible. And what is the meaning of this zero risk hedging? Zero risk hedging, you can say that when there is a very neutral positions in the market by using option or futures that completely eliminates the loss from adverse price movements. Right? So that is zero risk hedging. Now the thing is there that a forward foreign exchange contract creates which type of obligation? So the correct answer is mandatory obligation to execute. Option C is correct here. Why is an option premium paid upfront by the option buyer? Why is an option premium paid upfront by the option buyer? C. Option buyer enjoys right without obligation, ability to choose the better of strike price or market price. The option seller carries the risk of loss and therefore that buyer pays the premium as the compensation. So what is the meaning of this strike price and market price? See, always remember strike price is fixed, that is predetermined price at which an option holder can buy or sell an underlying asset, remaining constant through the contract life. And spot price or market price is the current price at which asset is actively traded, fluctuating constantly based on market demand. So the correct answer is The correct answer is here, option C, to compensate the option seller for taking the risk. Option C is correct. Which factor does not influence option premium? Which factor does not influence option premium? Option premium. What is the meaning of that option premium? Option premium is the upfront, non-refundable price a buyer pays to a seller to acquire an option contract. It represents the cost of the right but not the obligation. Why? To buy or sell an underlying asset at a set price before a specific date. And it is composed of intrinsic value and time value. And that is also driven by the market demand, volatility, and time to expiration. So option premium formula is intrinsic value plus time value, and that time value is extrinsic value. So which option is correct? Here, which option not influence? Option premium completely depends on volatility, on strike price, on time to maturity, on interest rates, and forward premium is related to interest rate differential in the forward contract, not option pricing. So here the correct answer is forward premium. Option D is correct. Now future contract differ from forward contract mainly because futures are future contracts. What is the meaning of that future contract? Future contract, as I told you, standardized legal agreement to buy or sell any asset like gold, oil at a predetermined price but at the future date. They are traded on a regulated exchange to manage the price risk or speculate on price movements. So, future contracts are traded on recognized exchanges. They are standardized in size and maturity. They are settled through the daily margining. So, forward contracts are OTC and as well over the counter as well as they are customized. So, which option is correct? Option C is correct, exchange traded as well as standardized. Now, currency swap type, coupon only swap. In coupon only swap, the borrower complete this statement. So coupon only swap means, yes, over the counter derivative contract where two parties exchange their periodic interest payments in the different currencies based on a set notional period, and they are not exchanging the principal. So in coupon only swap, principal remains in original currency, only interest payments are swapped, currency risk on principal still exists, and this is the commonly thing that is used. So which option is correct? Option C is correct, swaps only interest payments. Option C is correct. So which RBI requirement is aimed specifically at preventing mis-selling of derivatives? Yeah, RBI mandates bank to follow a suitability and appropriateness policy that ensures derivative products match the client risk profile. They have to understand the client risk, and mis-selling is avoided. Mis-selling is generally avoided. So that's why we can say RBI mandates that derivative product can be offered only to the corporate having a board approved management policy to avoid the misuse. So derivative means risk management tools. Treasury role is hedging, providing the client service and trading. Forwards are the obligation. Options are the right without obligation. Futures are exchange traded forwards. Swap is cash flow exchange. ISDA is a mandatory documentation. RBI is the regulator and FVIL is the benchmark authority. Right. Now I want to clear one thing about one term is there, FIMDA. What is this FIMDA? See, that is a basically you can say this is the industry body that played a very important role in the India's fixed income, money market and derivative market. And the full form of FIMDA is Fixed Income Money Market and Derivative Association of India. So FIMDA is the industry body that plays important role. They include pricing standards, dispute resolutions and market reports. They set the benchmarks, they do the market development, they guides, they provide the guidelines and the policies, as well as they publishes regular reports and analysis on market trends and the developments. Right? That is the role of FIMDA. Clear? Now, I hope that thing is clear, that what is the meaning of derivatives. Derivatives, simple, are the financial contract between the parties which derives their value from underlying assets like stock, bonds, commodities, currencies or market indices. There are common types of derivatives are forward, future, option, swap. Forwards are the derivative who are customized non-standardized contract between the parties and they are traded over the counter. Futures are the standardized contract based on traded on exchanges to buy or sell an asset at a fixed price or on a future date. Options are the contract that give the right but not the obligation to buy or sell an asset at a specific price. Swaps, derivative which is used to exchange cash flows such as interest rate swap. So derivatives are used by the investors, speculators, corporations to manage what? Exposure to the market volatility. So in today's class, we are going to discuss about asset liability management and treasury. Both are the important things for a bank to manage the asset liabilities and also the treasury. So today we will see some concepts with the help of MCQs that will brush up our concepts. So let's start with the class and start giving the answers in the comment box. First question is there. Asset liability management is primarily concerned with that asset liability management. These questions are they're designed to just solve your all the doubts, basic doubts related to this chapter. So try to give the answer of every question. First question is asset liability management is primarily concerned with. Four options are given here. So what is the answer? Simple. If I explain you, imagine there is a bank who is a like balancing rope walker. On one side, assets are there like investments, loans. On the other side, liabilities are there like deposits and borrowings. If one side becomes heavier, right? If one side becomes heavier and the uh, that walker fails on the rope, right? So ALM is like that. This is the balancing pole that keeps the bank steady. That's why ALM is defined as protection of net worth of the bank. That is the protection of net worth of the bank, right? So ALM is primarily concerned with protecting the net worth of a bank. That is the asset liability management, one of the important concept in our module C, which is the practice of assessing and reducing a company's risk of not paying a liability on time. Right? Next question. Next question is liquidity risk mainly arises due to liquidity risk mainly arise due to what is the answer here? See, as a bank promises all the depositors, come anytime, I will give your money, right? Banks say to the depositors, come anytime, I will give your money. But the same bank give the loans saying that pay me back after 5 years, no problem, right? That the same bank is saying this statement also. So here, one fine morning, depositors come together and they are just started asking for money. But loans are locked. So this timing mismatch creates the liquidity risk. That is the timing mismatch that creates the liquidity risk. So liquidity risk mainly arises due to mismatch between assets and the liabilities. So option B is correct here. Next question. When advances are more than deposits in a time bucket, the gap is when the advances are more than the deposits in a time bucket, then what is that gap? Then what is that gap called? Very simple. You can take the example like think of a monthly household budget, right? When the salary comes, that is the source. EMI plus expenses means the salary is used. If expenses are more than the salary, that is the stressful situation. But if salary is more than the expenses, that is a comfort situation. So in the banks, the difference in each time bucket is called liquidity gap. The difference in each time bucket is called that liquidity gap, right? So what is liquidity gap? That is the difference. And also you can say this is a mismatch of short-term assets and liabilities. And in banks, a negative gap occurs when liabilities maturing exceed the assets. So the current answer is option C, positive gap. Option C is correct here. Right? Now, the next question. RBI has prescribed time bands for monitoring the liquidity risk. RBI has prescribed the time bands for monitoring the liquidity risk to see. Very simple. RBI has prescribed some time bands. RBI is behaving like a strict school principal. It says that don't tell me anything in annual figures. Tell me what happens tomorrow. What will happen in next week? What will happen in the next month? That's why RBI uses the time buckets. Like next day, 2 to 7 days, 7 to 14 days, and also that 15 to 30 days to just catch the liquidity stress early. So it helps in measuring the liquidity gaps. That's why RBI has prescribed time bands for monitoring the liquidity risk. Then interest rate risk means interest rate risk. See, bank pays depositors only 8%, right? Suppose bank is paying to the depositors only 8%, but suddenly a market rate jump and new depositor cost become 10%. But the all old loans earning 8.5%. So in that case, income does not rise, but expenses rise. So in that case, that NII will fall, which is called the interest rate risk, which caused interest rate risk. And we know that NII means NII is net interest margin, net interest income, which is the difference between interest earned minus interest expense or interest paid. It is a primary measure of a bank profitability and lending efficiency. That is the NII. So which answer is correct here? The answer which is correct, that is interest rate risk, because of there is a risk of erosion of the NII. So option C is correct here. Now, liquidity risk translates into interest rate risk because liquidity risk translates into the interest rate risk because which option is correct? So read the question, try to give the answer that which option is correct here. Very simple. Suppose bank run short of funds. Now to survive, it borrows urgently from the market. Market says today rate is high. Take it or leave it. Now liquidity pressure forces borrowing at higher interest rate, which means liquidity risk are turned into the interest rate risk. So that means liquidity risk translates into the interest rate risk because funds must be recycled or rolled over at the market rates. That funds must be recycled and rolled over at the market rates. So the option C is correct here. What is the core function of treasury? Core function of treasury. So which one is the correct answer here? See, treasury is like a bank's control room. All the money flows through it. It decides when to invest, when to borrow, how to manage the interest and liquidity risk. That's why treasury sits at the heart of ALM. So, this treasury core function is to do the fund management. Fund management. So, option B is correct here. Treasury is like a profit center for the banks. So, we can say the correct answer is option B. Now, derivatives are mainly used in ALM. Why? Derivatives are mainly used in ALM. Why? Very simple. We know that these derivatives are used in ALM just to hedge and just to reduce all the financial risk, right? Particularly those which are arising from the mismatches between the interest rates, maturities and currencies of assets and liabilities. Bank fears that interest rate may rise, so it takes a derivative position like buying the insurance. If rate rise, there is a loss or loan, but derivative gives the profit. Balance are restored here. So derivatives act like a seat belt, not a race car. So which option is correct here? Here they hedge the liquidity and the interest rate risk. Option C is correct here. Which option is correct? Option C is correct. Now, credit derivatives are used to these credit derivatives are used to credit derivatives. What is the meaning of credit derivatives? They are the over-the-counter financial contract which are designed to transfer the credit risk, especially the risk of debtor defaults from one party to another without transferring the underlying asset. They allow the investor to hedge, speculate, or diversify the exposure to corporate or sovereign debt. They uses the instruments like credit default swap, total return swap, and credit spread options. So if bank has a loan but does not want the risk, they want only the income. So it says you take the risk, I will pay you a fee. Credit derivatives unbundles that credit risk. So risk become tradable and capital become free here. So the correct answer of this question is simple. It separates the credit risk from the loan assets. So option B is correct here. Now, which of the following can act as a market maker as per the RBI guidelines? Market maker. You can think that market maker as a shopkeeper in a busy market. He always be ready to buy and sell the things. So RBI, the same thing is with the RBI. RBI allows only strong, experienced players to run this shop. What? Commercial banks, primary dealers, NBFCs, which are having the good financial strength. Weak players are not allowed to keep the shop open or to keep the things ready. So that, what is the meaning of that NBFC? Non-banking financial companies. These companies are those financial institutions which are registered under the Companies Act, that provide banking related services such as loans, advances, leasings and investment without holding a full banking license. They can't accept deposit like the banks. They are regulated by the RBI. They are very important for the financial inclusion. They do lending, they do leasing, they do hire and purchase. And also they basically do investment in securities, and sometimes they do insurance also. The examples of NBFCs in India is Bajaj Finance Limited, Muthoot Finance Limited, Tata Capital Services Limited, Geo Financial Services. These all are the examples of NBFCs. So, which of the following can act? Simple, the commercial banks, these PDs, NBFCs, with having the like sound officials. Sound financials means which are financially healthy. They don't have any problem, right? So now that PD, what is the meaning of PD? That is primary dealers here. Now insurance companies, mutual funds, they can act as market makers. But how? Insurance companies, mutual fund, they can act as a market makers. But how? See, see, uh, yeah, that is correct. Yes, insurance companies and mutual funds, they can act as institutional market makers that provide liquidity in the specific segments of financial market, right? So here we can say that insurance companies already have a boss, which is IRDAI. Mutual funds also having a boss, SEBI. So RBI politely says, if your regulator allows, then you can enter my market. So here is the control which is dual, regulatory discipline. So only permitted if their respective regulators are allowing. So option C is correct here. Now, which of the following is not a user entity? Which of the following is not a user identity? Which option is correct here? Very simple. What are the users? They are like the customers in the market, right? They are like the customers in the market. They come just to hedge the risk, not to make the market. Bank corporates, PFs, FIIs, they all need the protection from the banks, right? They all need the protection from the banks, and basically RBI is the referee, not a player. So the correct answer is only the RBI is not the user of the any entity, right? So if we learn here some thing that I want to tell you, that we know that asset liability management is important, right? Asset liability management is just a practice which is used by the financial institution to mitigate any type of financial risk which is resulting from a mismatch of assets and liabilities. And yeah, if we see these things as a strategically, so that matching of asset and liabilities, in that financial institutions, they achieve some greater efficiencies and also profitability while also reducing the uh, risk. And what is the role of treasury in the ALM? That is simple fund management. It automatically gives liquidity and interest rate risk, and that treasury maintains the pool of bank funds, right? Then we know that there is one more thing, that market makers are completely, I told you, commercial banks, PDs, non-banking financial companies. They should have sound financial and good track record in providing the credit facilities, and any other institution if they are permitted by their RBIs, by their Reserve Bank, right? So the correct answer of this question is simple, only RBI. The next question is transferring pricing. So let me tell you the meaning of that transfer pricing. What is the meaning of transfer pricing? That refers to fix the cost of resources and the return on assets of the bank in a rational manner. And treasury notionally buys and sells the deposits and loans of the bank. And the price at which treasury buys and sell forms the basis of our assessing profitability of banking activity. Treasury is responsible to determine the buy and sell price on the basis of market rates of interest and the cost of hedging market risk and the cost of maintaining reserve assets of the bank. And there are very different types of ways to arriving at the transfer pricing, and the bank has to formulate a great policy in this regard. Once this pricing is implemented, treasury takes care of the liquidity, interest rate risk of the entire bank and the profit of the credit department. And when there is a multi-branch environment, transfer pricing is particularly useful to assess the branch profitability, right? So what is the answer of this question? Transfer pricing, simple. We can say, imagine a bank is a joint family. Treasury is the head of the family. Branches say, I will collect the deposit, I will give the loan. But treasury decides that I will decide what price I buy and buy the deposits and what price I have to sell the funds. That internal pricing system is called transfer pricing. So which option is correct? Option C is correct. Fixing the internal cost of funds and return on assets is the work of the transfer pricing. Option C is correct. Once the pricing is implemented, treasury is responsible for, I told you that thing, that if once the pricing is implemented, then treasury is responsible for, Kishore sir, answer D option. Okay. Simple, very simple. Let me tell you the logic. Treasury tells the credit department that you focus only on whether the money will be paid by the borrower or not. Treasury itself handles liquidity mismatch and interest rate movements. Credit department profit now reflects pure credit skill. So option C is correct. Liquidity and interest rate risk of the bank. So option C is correct here. Liquidity and interest rate risk of the bank. Option C is correct here. Now, transfer pricing is especially useful in multi-branch bank because transfer pricing is especially useful in multi-branch bank because see, the correct answer of this question, suppose branch A has cheap deposits, branch B has costly deposit. Without transfer pricing, there is a comparison that is unfair. But with the transfer pricing, Treasury give some internal rate to all the branches. Now profit shows real performance, not the luck. So we can say that transfer pricing policy prescribes the methodology and also segregate administrative cost and hedging cost. And integrated risk management policies bears the market risk of the bank. And it should ideally have some components like ALM policy, investment policy, transfer pricing policy, derivative policy, liquidity policy. Everything is mentioning any norm. And these policies should be approved at the highest level, either by the board or by the board committee. These policies have the should be according to the regulations of the RBI and other regulatory bodies. They have to follow the current market prices and whatever the code of conduct applied on this. And monitoring committee should be there, which ensures that everything is according to the rules and regulations in the policy. And all the policies need to be reviewed on annual basis because there is a requirement also. And these policies copies should be filed with the RBI. It should be submitted to the RBI also. Right. So transfer pricing especially, we can say it helps where in assessing the true branch profitability. So option C is correct here. Now ALM can be effective only if, when ALM is effective. Simple. ALM can be effective. ALM is like ALM without policy is like driving a car without traffic rules. Strong policies act like speed limit, signal, seat belt. So the same thing is there. ALM is effective in making a policy foundation very strong. So the correct answer of this question is option C. That means there is a strong policy foundation. Now, ALM policy mainly covers what? That ALM policy covers what? Simple answer is there about the ALM policy, that this ALM policy mainly covers the strategic management of the financial institution balance sheet, which focuses on balance asset, liabilities to optimize the earning while managing the risk. ALM policies covers the following areas: liquidity risk management, interest rate risk management, asset liability matching, capital management and planning, currency risk management, profit planning and growth projection. governance and reporting too. So that ALM in ALM answers the questions like who sits in ELCO, how do we measure the risk, how do we protect the NIM. It is the constitution of the ALM. So it covers compositions of ELCO and risk management framework. Option C is correct here. Liquidity policy prescribes what? Liquidity policy prescribes but what? And I told you, I think, about types of policies. We can say that this liquidity policy prescribe minimum liquidity to be maintained, funding of reserve assets, limits on exposure to money market, contingent funding, interbank committed credit lines, etc. So this prescribes the framework, strategies, operational boundaries, how to manage the institution bank's liquidity risk to ensure that it can meet its financial obligation as they become due under both normal and stressed condition. So liquidity policy is the bank emergency oxygen cylinder, which ensures minimum liquidity buffer is there, backup funding is there, credit lines is there. So bank never worried about the cash. So the simple answer is there, minimum liquidity and funding arrangements. Option B is correct here. Right? Now, derivative policies mainly deals with derivative policies mainly deals with derivative policies. Let me tell you about the derivative policies. Very simple. They prescribes the norms for the use of derivative, capital allocation, restrictions, valuation norms, exposure limits. So derivatives are the powerful medicines. If correct dose is there, cure is there. Wrong dose is there, disaster. So policy fixes how much to use, who can use, how to value. Safety first here. So the correct answer is exposure limits and valuation norms. Option C is correct here. All the ALM related policies must be approved by all the ALM related policies must be approved by C. Policies decides the future of the bank. So only the highest authority can approve them. Board approval means accountability. So all the ALM related policies, they are basically approved and prescribes the composition of asset liability management committee, operational aspects of the ALM. They include risk measures, monitoring of risk, risk neutralization, product pricing, and also how to improve and maintain the existing NIM. So the correct answer of this question is simple, that all the ALM, they have to be board and board level committee. So option C is correct here. Policies must comply with the codes which are evolved by. Policies must comply with the codes which are evolved by C. market players are agree on good behavior rules, and these rules are framed by self-regulatory organizations like FIMDA and FEDAI. Bank have to follow market ethics, not just laws. So what is that FIMDA? Fixed fixed income money market, fixed income money market and derivatives association of India, right? And this FEDI is what? This is foreign exchange dealers association of India, which is a self-regulatory organization established in 1958. Basically, they are both are established to set the rules, standards, and best practices for their respective domains. This FEMDA incorporated in 1958, which covers bond, money, and derivatives market. While this FEDAI, this FEDAI is a self-regulatory organization which governs foreign exchange market. FIMDA purposes promotes market development, transparency, and standardization is fixed income. Whereas FEDI, this act as a self-regulatory body for the authorized dealers in the foreign exchange market. They set the rules for interbank forex transaction, establishes the guidelines for merchant forex business, and provide daily periodical rates to member banks. So the correct answer is FEMDA and FEDAI. Right? Okay.